So you want to have a bigger buffer, even if that means a lower cap, because again, they're not trying to appreciate as much as they are maintain their quality of life in the portfolio.
So you're not worried about derivatives, you know, the famous Warren Buffett line, they're weapons of mass financial destruction?
Right. No, I don't think these aren't credit default swaps, and they're pretty liquid. So I think we're good in that regard.
All right, Ivory, with some innovative strategies here for folks in their 50s, 60s, and 70s. Thank you for joining me.
No, you're welcome.
Ivory Johnson of Delancey Wealth Management. Now, how about the FANG names? They have been the market leaders for years now, but they've also been hit hard this week. Apple alone is down 15%. So does the sell-off present a buying opportunity? We will dig into that next, right here on The Exchange.
Room for 7, and much, much more. The first ever GLB. Lease the GLB 250 SUV for just $419 a month at your local Mercedes-Benz dealer.
I always thought it was me, that I was the reason all these diets never worked.
This is genuinely not a temporary fix. There's some serious psychology behind it.
It's funny how much smarter I feel like Noom has made me. It's the simple things.
Once I understood why I was making those choices, it was easy for me to change those habits, and weight loss came naturally after that.
I've been on Noom for 4 months now. I've lost 27 pounds, and I feel like I got my life back.
Visit Noom.com and lose the weight for good.
And Doug.
And now, for their service to the community, we present Limu Imu and Doug with this key to the city.
It's an honor to tell you that Liberty Mutual customizes your car insurance so you only pay for what you need. And now, we need to get back to work. Only pay for what you need.
Wondering which credit card is right for you? Introducing CNBC Select, the authority on all things credit cards. We do the research, you reap the rewards. Head on over to cnbc.com/select and take control of your money.
You went to college? You're smart. So why are you getting ripped off on your student loans? At Credible.com, we've helped tens of thousands of people save money by refinancing their student loans. In 3 minutes, we'll get you actual rates from multiple lenders. We could save you hundreds of dollars a month by refinancing to a lower rate. Don't get ripped off on your student loans. Let's focus on your future, not your debt.
Visit Credible.com and in 3 minutes, see how much you could save.
Hey guys, welcome to HIMS.
Should have done it years ago, and I feel like the young stud that I always imagined I was.
Let's focus on your outstanding product, not your debt. Above and beyond our expectations.
Go to forhims.com/easy and get started with the free online visit. Welcome to
This is a crate from KiwiCo. Each crate has an awesome science, art, or engineering project inside. Parents can order online and it ships right to your door. Learning has never been so fun or so convenient. Get your first month free at trykiwico.com.
Welcome back. Technology has been one of the worst sectors this week. And look at the Dow just now. We're down 890 points. So we're heading back towards the session lows, and we were down more than 1,000 in the session today. The NASDAQ actually was relatively a better performer and still is. So the Dow's down 3.5%. The NASDAQ's down about 2.25%. The S&P is down 87 points, nearly 3% right now. We'll obviously continue to watch it closely. And tech has been at the epicenter. It fell about 15% as a sector this week. Let's drill down on the FANG names in particular. And for that, Josh Lipton joins us with a look at just how they're faring. Josh?
So, Kelly, FANG falling hard here. Facebook, Amazon, Apple, Netflix, and Google parent Alphabet have now collectively lost about $628 billion in market cap from their recent highs. And just to put that number in perspective, that's more than Walmart and MasterCard combined. Apple, Alphabet, Amazon, and Facebook all trading in correction. Netflix, by the way, the 10th best performing stock in the S&P this week. That's down about 4%. Analysts saying it is an obvious beneficiary if consumers decide to stay home due to virus concerns. Kelly, back to you.
Okay, Josh, we appreciate it. Tech has gotten pretty beaten up lately. My next guest says he's tempted to buy some of the big names. Joining me now is Paul Meeks. He's a portfolio manager at Independent Solutions Wealth Management. Paul, welcome. And what looks most tantalizing to you right now?
As we did in Europe, as we did in Asia Pacific.
Now, Josh just teased into the FANGs. Actually, among the FANGs, the only one that I'm incrementally bullish on is Amazon. I have some more fundamental issues, even pre-coronavirus, in some of the others. I think within the payment processors, which a lot of people don't know, but they're very large exposures in any of the tech indexes, MasterCard and Visa. Now, MasterCard did have a negative announcement the other day. They are directly intertwined with what's going on in Asia with the coronavirus. But here is a great company. And if you have a long-term perspective, I think MasterCard is going to be a wonderful investment.
You know, I see you also like Micron and Adobe. Before we get into those, since you started with FANG, said only Amazon might interest you, and we're still not there yet. Why aren't you jumping onto this Netflix bandwagon, this idea, hey, everyone's going to stay at home, and so you should buy the stock?
Yeah, that's a tactical reason to buy. The reason I stay away from Netflix is the continued cash burn and also, of course, the onslaught of other competitors. Apple, I'm worried about that we will not see, even X the coronavirus, this big 5G super cycle for their iPhones. And, of course, Google and Facebook have some very serious regulatory concerns about privacy of customers' data.
So let's turn then to the names that you do like, Micron and Adobe here. Do they have direct coronavirus-related business issues, or do you think they've just been thrown out because people are selling everything these days?
Well, there's a distinguishing factor between the two. Micron does have ties to what's happening in Southeast Asia. Adobe, not so much. But the way I look at it is Micron has been at the bottom of its cycle for DRAM and flash memory chips. And once we get through the coronavirus, they were on a nice part of the business cycle. So I still think MU is going to be a good one once we get beyond the most damaging part of the coronavirus. Adobe Systems is a company that is a little bit different. Of course, it's a worldwide firm, but being a software company, it's more insulated from the coronavirus. But it's a company that's doing all the right things.
Yeah, I know a lot of these that you mentioned, Adobe, MasterCard, Visa, these have been the best names practically of the decade, so they would make sense, to buy them here on some pullbacks. Let me ask you about Amazon, which you said is more interesting to you than the rest of the FANG names, but you're still not ready to buy it yet. Too expensive, or is there another issue?
I actually just think it's the expense. They've reported a great quarter. And remember, despite being the mothership, they don't really have that much traction in Asia. And the company continues to be on a multi-year cycle of which they will lose some share, but they'll still remain a strong number one in the cloud. And so I'm very bullish on AWS, Amazon Web Services. I also think they have a embryonic healthcare business, an embryonic transportation business, and more than an embryonic digital advertising business. Each of those things could be multi-billion-dollar businesses for them.
Then what price gets Paul Meeks involved? It's trading at about $18.40 today.
I think a little bit lower, so we actually don't worry about the fundamentals because I have no concerns, but we find some kind of technical support that's probably down about 5% more from here.
All right, we'll see if that's true of the broader market as well. Paul, it's great to see you today. Thanks so much.
Thank you, Kelly.
Paul Meeks. We've got a news alert from Google, from Deirdre Bose, I should say. It is about Google, which we were just discussing. Deirdre, what's happening?
Hey, Kelly, that's right. Well, Google is confirming that an employee in its Zurich office has tested positive for the coronavirus. Now, it's not sharing any more details, including where that employee is now or where he or she may have or may not have traveled to. In a statement, I'll read this to you. The company says, we can confirm that one employee from our Zurich office has been diagnosed with the coronavirus. They were in the Zurich office for a limited time before they had any symptoms. We have taken and will continue to take all necessary precautionary measures following the advice of public health officials as we prioritize everyone's health and safety. Now, that office in Zurich remains open like all of Google's other offices, and they're going to continue to monitor the situation. Alphabet shares down about 2%, Kelly.
And the office does remain open, though. I guess that's probably the most important thing for investors, maybe for other Google employees right now.
Yeah, that's right. And certainly, of course, their headquarters is in Mountain View, not far from here. But again, I have to stress, Google is not sharing any more details. We don't know where that employee is, if they have left Zurich, if they've traveled anywhere else.
Okay. Deirdre Bosa, thank you. We appreciate it. Stocks have been selling off around the globe with the market on track for its worst week since October of 2008. That, of course, was during the heart of the financial crisis. The DAX in Germany, the CAC in France, the Nikkei in Japan, the Kospi in Korea, the Shanghai Composite, all falling more than 3%. And that's just today. Joining me now with more on this sell-off is Jurrien Timmer. He's Director of Global Macro at Fidelity Investments, which has more than $8 trillion in assets under administration. And Steve Auth is Chief Investment Officer for Global Equities at Federated Hermes, which has $89 billion under management. So welcome to you both. And Steve, I'll just start with you. Anything about coronavirus, I guess, why don't you tell us what you think the link is between the market sell-off that we've seen, the genuine coronavirus concern, and any panic that might be happening now because of all of this?
Right, it's all of the above. So it's kind of three risks that are coming together. One is the this is a market that needed a sell-off.
Absolutely.
We've talked about that. So it was very stretched, and we were expecting a 5 to 10% pullback. That would have been very natural. So start with that backdrop. You got the coronavirus as a health threat, which doesn't seem to be a world ender, but certainly is a kind of stealth virus, and that's got everyone nervous.
Let me ask you something. Are you yourself nervous about contracting the coronavirus?
No. One, as you know, I've got my spiritual life in order, Kelly, so that helps. But beyond that, 80% of people infected, it's very low grade. It's normally people with other complications that, have something really a threat. And even there, the death rates are not terrible. It's hard to talk this way, though. A lot of people die from this. It's not good.
Of course, I only ask because I think the main reaction I hear from people who are watching the show and in the markets is the media generating panic? Is there a genuine reason to be concerned out there? And is the market accurately reflecting that or not? So disentangling those threads is what we're trying to do.
It's the screaming fire in the crowded movie theater. It's worse than the fire itself, right? People trip over themselves. That's a little bit what's going on now. But there is an economic threat here, at least short term, as people slow down work. China kind of shut down for a few weeks. It looks like that would be very, very short term. There's no systemic risk in the financial system. But the third risk, I think the market is grappling, you can see it in the healthcare stocks on Monday, is what if all this leads to, let's say, Bernie Sanders, which I've long said is a 20% haircut on stocks, but we're almost at 20% down now.
Right,
so,
exactly.
And it's not a 100% chance for Bernie. There's still a lot between here and the end of the year. So our view is we're telling investors, and what we're doing is we're legging in here. It's very hard to call bottom. We're not traders. If you go out 3 years from now, stocks are likely to be higher. Okay. Even if you bought down the first 20% in 08-09, 2 years later, you were at least break even, and 3 years later, you were in very good shape, even though there was some scary declines after.
And now that's all ancient history, of course.
Right.
Although at the time it felt quite scary. And Jurrien, I know you lived through that episode as well. So the most notable thing about the sell-off, because as Steve is saying, it was overdue. You had all of the extreme greed flashing, saying a correction was coming. The speed of this one is the fastest ever. And the levels of bond yields are at record lows. Do those two things make you change your investment strategies or your thinking about the economy here?
No, they don't, because my investment strategy is to be in a 60-40 portfolio, some variation of a broadly diversified portfolio. And, the bonds side of the equation is certainly helping out a lot this week. And, as Stephen was saying, the market was priced for perfection going into the year at a 19.1 forward multiple. It needed that earnings rebound to really happen on time as scheduled. And, of course, that's not happening. And so what we're seeing is some price discovery and a reset. The P is down to 16.3. That's down 15% in 4.5 days. It's a very sharp reset. But what's clear is that what's going to happen is that in Q1 is going to be a kitchen sink quarter. Every company is going to pre-announce and guide lower. China will probably print a minus 5% GDP because everyone has sort of cover to just write everything selling off, and then the hope is then the hope is for the V, and then we obviously don't know. And as Stephen said, there's a political aspect now to it as well, and maybe that brings with it a large fiscal response, not just the Fed but fiscal as well. So there's a lot of moving parts to this, and right now the market is just grappling with the price discovery.
So do you share Steve's point of view, if I could summarize it this way, which is that we are working towards forming a bottom, maybe closer to the end than the start of the sell-off, you'd hope, now that we're down 15 or 20%, whatever the number is. And are there any indicators you'd look for, whether it's gold or we mentioned bond yields, Fed funds futures, what would tell you kind of where we are in that process?
Yeah, well, so it's interesting. So right now, the VIX went up to about 50 this morning. The equity risk premium, so the differential between bonds and stocks, is at 5. That's actually higher than it was at the December 2018 bottom, which was down 20%. So the market has certainly come a long way. And if you look at the leadership today, gold down, quality stocks down, that kind of reminds me a little bit of 08. Not that I think this is anything like 08, but towards the end, when kind of voluntary selling, if you will, led to forced selling, margin calls. When you see that happening, investors end up selling kind of what they can and not what they want. So the fact that the defensives are selling off maybe is a sign that we're kind of building that final crescendo. But having said that, after a 15% down week, the market's going to do a lot. It's going to have to do a lot of base building to kind of set up for the next up leg, and that could take a few months here. Okay, so people need to be patient, which I guess means they have plenty of time to think about dipping their toes back in. We'll leave it there. We thank you both very, very much. Yuri and Timur, Steve Auth, it's great to see you today. And that does it for the exchange. I'll go see you on Power Lunch with Tyler.
And Kelly, we will see you in just a moment when you amble on over. Welcome everybody to Power Lunch for a very busy Friday. I'm Tyler Matheson. It has been, by any measure, a punishing week for your money, and it is showing no signs of letting up as we are just now 2 hours away from the closing bell. This is where the action has started heavily this week. The Dow off the lows of the session, but still down, as you see right there, 875 points. On track now for its worst weekly point loss ever. This is a week of never-befores and not-sinces. The industrials falling nearly 4,000 points on the week. This will also be the worst week, worst month, worst start to the year since the crisis in 08 and 09. Not since more than a decade ago have we had such a rough beginning to a year. And then there's this. Roughly 95% of the S&P 500 is now in correction territory, meaning down 10% from a recent high, and nearly half of the S&P 500 is in a bear market situation, off 20%. Kelly?
Very good. Tyler, thank you. I'm Kelly Evans. Welcome to Power Lunch, everyone. Our team coverage of this market sell-off does roll on as the coronavirus fear and impact spread. Bob Bassani is tracking the volatility, which has been big today at the New York Stock Exchange. Rick Santelli is watching rates and bonds move lower, or maybe try to move higher a little bit lately. He's out at the CME. Meg Trail has the latest on the outbreak for us. Eamon Javers is in D.C. with the administration's response. And Steve Leisman is focusing on the Fed's next move. We begin with Bob Bassani to wrap up the market's 3,000-point drop this week. Bob?
We're looking for signs of capitulation, signs of some kind of bottom, but it's very hard to come by. I want to show you the Dow Jones Industrial Average last 2 days. You see, same thing happened today, it happened yesterday. 1:30, 2 o'clock, market starts drooping. It's happening again here. Now, some of this likely is due to margin calls, things like that. Gold's acting a little strange, too. That is likely what's going on. But, again, we want to find a bottom here. Microsoft, good indicator here. Massive moves in the last couple of days. Not really telling us much. Again, the sell-off in the middle of the day. So it's very hard to determine whether we're near any kind of level where the market's comfortable at this point. What's clear is we've got these checklists of things that traders used to look at to figure out whether we were at bottoms here. And most of them scream buys here. So extreme oversold conditions in the markets. Oh, that's for darn sure. New lows expanding at the NYSE. Nearly 1,000 new lows at the NYSE today. Extreme VIX readings. We've seen 2-year highs. The VIX is in backwardations. So a lot of this, basically, this tells traditional traders buy the markets here. Junk bond outflows, massive outflows. Yes, retail sentiment, it's down, but not extreme panic. Most of this says buy the market, and yet people say, we don't know. This may be a very unique situation where you get these crazy oversold levels for weeks on end, way beyond what normally would occur. Take a look at the haircut the market's taken, and the high on February 19th, U.S. equity market capitalization, 33 trillion. Today it's 29. We dropped 13% in just a couple weeks. That's an extraordinary number. Finally, the important thing is, how did trading hold up? We had panic selling going on all throughout the week. Overall, I'd say the numbers were pretty good. No circuit breakers were hit. Remember, there's a circuit breaker. S&P drops 7%. The market basically stops for a short while. Bottom line is, that didn't happen. We also had no tape delays or breakdowns that I was aware of here in the United States. And we had no big ETF issues, no big blow-ups in the ETF space overall that I heard about. I think this is pretty good indication the market's held up under extreme levels of stress. Guys, back to you.
All right, Bob, thank you very much. Bob Pisani at the New York Stock Exchange. Let's go from the stocks to the bonds. And if it's been a busy week for stocks, it has been equally busy in bonds. The 10-year hitting fresh all-time lows today. And Rick Santelli is covering it all for us from the CME. Rick?
Yes, Tyler, and not only 10s, but 30s hitting all-time lows as well, and the entire curve under pressure. Just to give you an idea, 2-year note yields right now are down 44 basis points for the month. 10-year note yields are down 32. 30-year bond yields are down 25. Now, look at a month to date of the aforementioned 10-year notes. We started the month at 150. We're ending the month at 115. So for the month, it's down 35. These are huge numbers. When you put them into percentages, it makes one perspire. Look at a month to date of our 10-year versus the European 10-year. It's now at 176. Just in a week, it's gotten 14 basis points closer, the closest it's been since September of 2017, because our rates are going down much faster, kind of catching those negative yields in Europe. And finally, let's look at what's going on with 30s to 10s. We know 10s to 2s is steeping, 30s to 10s is steeping rather dramatically as well, steepest since August. What does this mean? It means all the distortions are on buying on the long end and stuck on the short end. Kelly, back to you.
Thank you, Rick. Rick Santelli, let's get the very latest now on the coronavirus. Global cases now exceed 80,000, deaths reaching nearly 3,000, and the World Health Organization raising the alert to very high. Meg Terrell is here with the very latest.
Well, hey again, Kelly. That increased risk assessment comes as the virus has spread now to at least 56 countries, and new infections outside of China are surpassing those in China. The World Health Organization, though, emphasizing there is still time to contain the virus if countries move quickly to detect cases, isolate and care for patients, and trace their contacts. Among the countries hardest hit, South Korea with more than 2,300 cases, Italy with more than 650, Iran at almost 400, and Japan with more than 200. Mexico became the second country in Latin America to report cases, 2 men who had recently visited Italy. In the U.S., the CDC today addressing the first potential case of community transmission, a patient in California with no known travel history to an affected area or contact with the patient. Dr. Nancy Massonier saying health officials are now working to trace back how that patient was exposed and identify contacts. She said it's possible the investigation may show the patient was exposed through contact with an infected traveler, which, guys, would mean we don't have this circulating in the community. They are still investigating.
How do we put into sort of the good news, bad news scenario the idea that new cases are growing faster now outside of China, but slowing in China? Is the fact that they're slowing in China, I've got to say in absolute terms, that sounds like good news.
Yeah, I think public health officials are encouraged by the fact that you are seeing cases decline there, and the WHO pointing to that as evidence that those kinds of extreme measures we saw in China work. However, there are lots of questions about whether those measures can be extreme in other countries for a number of reasons. And so the number of cases we are seeing outside of China is very alarming.
All right. Meg, thank you very much. Appreciate it.
Now to the White House, where the administration is trying to calm the markets and the nation. Eamon Javers is live for us. Eamon?
Yeah, Kelly, that's right. The message from here at the White House is, look, simply don't panic at this point. Larry Kudlow was out in the briefing room talking to reporters earlier today, suggesting that the risk here to Americans is low. He also said that the administration is not going to take any dramatic or what he called precipitous actions here to support the stock market at this point. They don't want to do anything here that makes it look like they're really concerned about this. They feel this is the natural course of events, stock market reacting to headlines. There is some defensiveness here inside the White House. They feel that they've not gotten enough credit for the actions that the president has taken so far. Mick Mulvaney, the acting White House chief of staff, speaking to that earlier today at a conservative conference here in Washington. Here's what he said.
We took extraordinary steps 4 or 5 weeks ago. Why didn't you hear about it? What was still going on 4 or 5 weeks ago? Impeachment. And that's all the press wanted to talk about. The reason you're saying so much attention to it today is that they think this is going to be what brings down the president. That's what this is all about.
So the acting White House chief of staff there saying that media coverage of this virus epidemic is because the media wants to bring down the president. So there is some sense here that they're sort of under siege at this White House from the media and elsewhere and some of their critics. But nonetheless, they say ultimately no dramatic action happening today, at least in terms of the stock market. And the message from here, again, don't panic. This is going to be over soon.
All right, Eamon, thank you very much.
You bet.
Appreciate it. Now to the pressure mounting on the Federal Reserve to cut rates in response to the sell-off and the slowing global economy. And Steve Leisman has the very latest. Steve.
Yeah, Tyler, I just want to give you the absolute very latest. I just got a report from Bank of America. They are calling for a 50 basis point rate cut. That is now their call for the March meeting. Really one of the first investment big. And not only that, they're saying that a surprise rate cut or an intermediate cut is possible, an emergency cut. Now, markets are reacting to commentary today from St. Louis Fed President James Bullard, where he joined other Fed officials in appearing to lean against any near-term rate cut. Bullard saying the Fed could cut rates if a global pandemic actually develops, but that is not the baseline case. That followed comments yesterday from Chicago Fed President Charles Evans, who said Fed action would be, quote, premature until we have more data, followed by or preceded by Fed Vice Chair Richard Clarida on Monday, who announced it as, quote, still too soon to even speculate whether coronavirus will lead to a change in the outlook. While all that's going on, you just heard what I said about B of A. The markets are leaning against, they may be leaning against it, but futures markets continue to aggressively price in rate cuts. Take a look at these numbers we have here now. 100% probability of a rate cut in March. And Kelly Evans will remember that was 2 days ago.
Big from yesterday.
It was a zero, not up from yesterday, but March wasn't even in play 2 days ago.
Right.
But not only that, there's a 49% probability of a 50 basis point cut at the March meeting. If you guys would remember that number, I want to come back to that in just a sec because I want to show you the rest of the tenor out there, which shows that there is now, if you don't get 2 cuts in March, you would get a 69% probability of 1 in April. Third cut for June, 51% probability, 55% chance of a November 4th cut or a full percentage point being baked in. Former Fed Governor Kevin Warsh on Squawk this morning, reiterating his support for coordinated global rate cuts, a move he argues would give U.S. businesses some breathing room.
If this thing manifests itself in an ugly way, my instinct would be that Chairman Powell needs to reach out to his counterparts around the world and buy some time. That's what a quarter point could do.
All right, so I asked you to remember that 50 basis point cut possibility for March. Let's all do some simple math. If the market is baking in 50 or close to baking in, what would it take for the Fed to surprise the market?
True. But they haven't been doing that so much lately,
well,
right? They've just been kind of
meeting
them where they are.
What they wanted to do more or less in the crisis was, if the market expected this, in order to have maximum effect, they did that. So I don't even want to say it, but a 75 basis point
but still
would not necessarily be off the table if you think the Fed would want to surprise the market for maximum impact.
That financial crisis, though, was something intrinsic to the financial system. You know, it came about because of distortions there. It needed to be addressed there and mitigated that way. Can we say the same for coronavirus?
I would agree with the premise of your question. There is no evidence now that what's going on is inside the plumbing of the financial system. There's no sense at all that the market is not clearing. We had a bit of a debate on halftime. It is a crash of the market, but if you look at the way it has gotten to those prices, as far as I can tell, we haven't gapped down. There's been nobody who's been out there here's a security, and people can't sell it. That would be a drying up of liquidity. We don't have that evidence yet, Kelly, so you're absolutely right that perhaps the kind of emergency stuff that I'm talking about would not be warranted.
Who or what would a rate cut help?
There's a big debate about that. You could argue that if banks are reluctant to lend, then at a certain lower interest rate, they might be more borrowers are reluctant to borrow, that at a certain lower interest rate, they would be more willing to borrow and do certain things. There are parts of this crisis that would appear, however, to defy any impact or stimulation from Fed rate cuts. Like, for example, the absence of supply from China, the unwillingness of people to go and do certain spending would not necessarily, we talked about this.
I mean, is it going to increase my propensity to spend?
Honey, let's go to dinner because interest rates are lower. No, or let's go to a concert where you risk getting coronavirus.
Let's go buy a pair of Pradas.
Right, exactly. You can imagine, though, if we develop what Kelly's talking about, which is concern, either spreads blowing out or some situation like that where it becomes a financial issue, it would have more effect. You could imagine other things the Fed could do. My best guess right now is Jay Powell is hunkering down with his advisors and trying to get creative. The message I'm getting from the wall that we put up and the comments made by Fed officials is that they don't want to cut rates here.
Yep.
And they may want to try some other means to try to simulate.
I know you've said they've never done this regulatory forbearance on small business loans type of thing, but now would be a great time if we're talking about extraordinary measures. Why not give that a try? He's a lawyer. It seems more like it could be up his alley.
Kelly, it's a good idea, but imagine the optics of it vis-a-vis the optics of a rate cut. If I come on and say the Fed has an emergency announcement that it's giving regulatory forbearance to small business, I might get a collective yawn, or they might throw something at the television and say, where's the rate cut that I demand?
Right. No, that's absolutely true.
All right, Steve, stick around as we chew a little bit more on this with our team of market watchers. Here with us, Quincy Crosby, Chief Market Strategist with Prudential Financial. That firm manages $1.5 trillion, though probably a little less than that this week, right, Quincy? Not to be mean. And Mike Ryan, UBS Global Wealth Management, America's Chief Investment Officer. His firm manages $2.6 trillion. So there. Welcome to both of you. Quincy, what do you think of what we just talked about? Would a rate cut really help, and do you expect to see one?
You know what, I do expect to see one, because this reminds me of an elongated version of Christmas Eve in 2018, when the market was ferocious. And by the time we got to January 4th, the Fed had changed its mind about rate cuts. It changed its mind about the way they were going to unwind the balance sheet. So they do change quickly, despite what they say just a few weeks before that. If this continues and we start to see more pressure on top-line revenue growth, we have more companies coming out, and if we start to hear about layoffs, because what are companies going to do if they begin to think about layoffs? The Fed is going to come in.
Mike, are we watching the death of the bull market?
No, I don't think we're. First of all, let me go back to what was just mentioned about the Fed's response function. I think there's two things about the Fed. First of all, it's conditional, and second, it's interpretive. So the first thing to do is they need to assess economic conditions, and the second issue is you have to interpret what they think the impact is going to be in terms of how the fallout is, in terms of how deep it impacts growth, what it means for the financial system. So at this point, I think what the Fed is still doing, they're in the assessment phase. They're still going through and processing, how much fallout will it be? Right now, what we see is the domestic economy has actually held up very well. The biggest issue that I think is confronting Fed officials is really the tightening of financial conditions, and what could that mean to growth going forward. But no, I don't think this is the end of the bull market. I think what we're facing right now is a period of extreme and sudden sell-off in the markets in response to an unknown external threat. We do know what coronavirus is, but we don't know exactly how it manifests itself. No one can quite quantify exactly what the impact will be. So until we get a little bit more clarity on the depth of this crisis in terms of how far this health crisis is spreading and whether or not it's sort of broken containment, I think it's premature to talk about bear markets or recessions.
Mike, can the Fed not respond here? I mean, that sounds like where you're going, and it sounds like you're kind of siding with what Fed officials have said, which is that it would be premature to do anything just yet.
No, what I'm saying, Steve, is that I think what the Fed will do in their response function is right now I think they're still in the processing mode. I think to pre-commit to action before they've actually seen anything show up in the data, I don't think that's in the Fed's thinking. I think what they will do, Steve, is that they'll continue to look at what's happening in terms of not only here globally, what the fallout is, I'm sorry, in the U.S., but also globally, and take that into consideration. And then the most important thing in the short term, of course, is these tightening financial conditions. Is this causing stress in the market, and is this going to wind up translating into a deeper economic outcome?
Quincy, as I'm going to come back to this, I saw you shaking your head. You don't think it could be the end of the bull market, but I'd point out 2 more days like today, and you're at a 20% decline, which is actually the tipping point for a so-called bear market. As more and more companies in the United States start to come out and say, here are the numbers that we're looking at, could this accelerate the decline as those companies start to put hard numbers or hard estimates on what they're seeing in their businesses?
Yeah, no, absolutely.
Because right now it's all speculation, mostly.
Now it's all speculation. I think that the worry is, if we want to look at a bear market or going into a recession, is we know that they're going to hold back spending. We knew that. They were going to hold back spending. It's whether or not they decide to let people go. Mm-hmm. Once that happens, that feeds onto itself, especially since 68% of our economy is consumer spending. And that's the biggest worry that you have. Because in terms of the market, one of the things we're seeing on the retail level is that retail investors are, I don't want to say calm, they're watching this, but from what we hear about from advisors is they're calling for guidance. And they're being told, look, we've gone through this. It's not 20% yet, which is going into another phase. But things can change rapidly. In other words, if you leave the market and go into cash, something could come either from the Fed or the government, or, by the way, this virus stops. This is man and the market against a virus, and that's why it's that. But companies don't care about laying off. They will do it if they believe that it's going to help their bottom line, and that sets the stage for something else. And that's where the Fed, I think, is watching to see what companies are doing. I think they're talking to CEOs. You know, their beige book is made up of anecdotal evidence.
Right.
It would be hard for me to believe they are not speaking to small business owners and to CEOs to see what their plans are.
So are either of you, and Michael, I'll ask you, but hearing panic from clients, you know, those kind of calls that say, hey, take me out of this market, or why did you have me in it?
Look, we're certainly hearing anxiety on the part of clients, because when you see this kind of a sudden sharp fall, it's not surprising that it certainly gets everyone's attention. We're certainly not seeing any panic moves. One of the things we've been counseling clients for a long time is you want to be not caught in these short-term volatility traps. What you want to do is focus on, okay, what we're seeing over the horizon that spans 6 and 12 months. So we haven't seen that kind of response function. I'll go back to what was said just a few minutes ago. I think, you know, we have to put these things in perspective. Look, there's a certain amount of humility that has to come with this process. There are things we still don't know. I think what the markets are starting to price in right now is some pretty extreme outcomes. I think what you're starting to see is the market is already discounting that this is perhaps reaching a breakout phase in terms of disease. Secondly, they're already discounting that this is going to have a significant and more sustained impact on economic growth. And those two are not certain yet. In fact, what we could well see is if this proves to be contained, and if we do see that this is more of a transient impact on the economy that lasts for a quarter or two, then what I think you'll see is markets will steady. And I also think what you'll see is corporate earnings, although they likely will be impacted, we will see, again, a recovery in corporate earnings probably in the second half of the year.
I mean, you know, maybe what I'm sensing, Mike, is the idea that the market underestimated the impact for the first few weeks of this outbreak, and now may be overreacting to it. Fair observation?
Yeah, I think that's a perfectly fair way to put it, Tyler. What I say is, look, when we think about these things, we have to approach them also not only with humility, with sobriety. And what we do is, initially, when we have any kind of event like this, we, as a species, we tend to underappreciate them, and then we overreact to them. And I think we move from the underappreciation to the overreaction phase.
All right. Thank you very much, Quincy. Good to see you. And Mike, thank you very much. Well, 2020 was supposed to be a year of growth for retail and consumer spending. But what happens if the coronavirus begins to hit Americans' wallets? Let's bring in Lauren Thomas to discuss it. What happens, Lauren?
Yeah, well, I think a lot of it is still up in the air, kind of in wait-and-see mode is how a lot of analysts describe it to me. There was a really interesting study, though, put out this morning. A firm, Coresight Research, polled about 2,000 Americans just earlier in the week, consumers, to see what places they would consider avoiding if this situation were to worsen here in the U.S. Number one, almost 75% of people say shopping malls. That more so than restaurants right now, as it stands, a lot of people are avoiding public transportation. So airlines, you know, maybe the subway, that's kind of top of mind to avoid right now. But if this situation were to worsen, this study is showing shopping malls is the number one destination that people would look to avoid. And obviously malls are already struggling with falling foot traffic, could deal potentially another blow to that space. But consumer spending makes up 70% of the U.S. economy. So it's really important, I think, to just monitor the consumer psyche right now. Are they looking to stockpile on, you know, necessities like toiletries and medical supplies? Hand sanitizer sales right now are booming. L Brands just said that yesterday. L Brands owns Bath and Body Works, and on their earnings call, they actually called out hand sanitizer sales as a growth spot right now, which is just really interesting in itself. But, you know, and if that consumer does start to pull away from maybe apparel, footwear, luxury, of course, could take a hit because of tourism. Just a lot of things to watch out for. But again, just because consumer spending is so vital to our economy and the growth that we've seen, it's key to watch here.
Yeah, Lauren, stay right there for more on the impact that we could see here from coronavirus on the retailers. Let's bring in someone who covers a lot of the well-known apparel companies. Susan Anderson is a retail analyst with B. Riley FBR. Susan, it's great to have you with us today. And could a company like L Brands, kind of get through this better? We just heard about the hand sanitizer. I know they have a myriad other issues right now. Okay, the stock is down humongous. Yeah. That's another thing. But how would you kind of separate out those who could see some positive near-term impact from those who will really be hit if we see a further drying up in mall traffic?
Yeah, so L Brands, the Bath & Body Works format, could benefit from the sanitizers that they sell. BBW is already doing well, so I think it's just cherry on top of the icing. But when you look at L Brands, them getting back into, say, bathing suits, for instance, we're heading into March now and the start of the spring selling season. Consumers, originally may have been looking to go on spring break vacations. Potentially those could get canceled if this gets worse and starts to spread, and maybe they don't buy that bathing suit that they were looking to buy. I think at this point, though, it's still too early to tell. We'll probably most likely see traffic down at the malls this weekend. I think consumers are starting to look to avoid public places, but 1 weekend or 2 weekends of down traffic probably will not hurt things. But if things do spread and get worse, I think March is more of a peak selling season for spring, and that could make a bigger issue for the retailers.
I guess a different way of stating it is, is the price action, what's priced in now with these stocks, in some cases down 15%. I would imagine it's at least a couple quarters of maybe dried up mall traffic. And also, I like the couple of names you highlight here, like a Carter's, maybe on the baby gear side, Skechers, American Eagle, Steve Madden. Why do you think they might be a little bit better positioned?
Yeah, so Carter's, I think, is very well positioned. It's more of a defensive play. If you have a 6-month-old, you're still going to need to buy apparel for them as they grow over the next 3 months. And they have a very robust online business, about 30% of their business. So you don't necessarily have to go to the store to buy that. You can purchase that online, and it's not something necessarily that you would postpone, unlike some other discretionary purchases. As Steve Madden, I think, while discretionary purchases could get postponed, if you're going to buy a pair of sneakers or a new pair of shoes, most likely that gets purchased when all this is said and done and things get back to normal. So, while it could get delayed, I think that it ends up getting made up in the end.
Sure. And Lauren, same thing you mentioned, the companies were already this week, in the case of Bath & Body Works, starting to talk about seeing an impact from coronavirus. But who are we going to hear from in the next couple weeks? Or sure. I wonder if anyone would come out and pre-announce. That's probably way too soon to talk about.
Right. Well, we've actually, I pulled some Refinitiv data earlier this morning, and so far, 66 retailers have mentioned coronavirus on their earnings calls this quarter, and we're not even through the thick of it. We still have reports from Kohl's and Nordstrom, 2 department stores next week. We've still got to hear from Gap, which has huge exposure to China. So I think we could see, a lot more to come. One thing that I wanted to build on, though, that she said with just e-commerce, Carter's, potentially they could have a strong baby business online. I think that'll be something to watch. If consumers in the U.S. now have to resort to shopping online, could that just, speed maybe the rate at which e-commerce sales, take over total retail sales here in the U.S.?
Yeah, and have a lasting effect in that way. All right, thank you both. Lauren Thomas, Susan Anderson, we appreciate it.
All 11 S&P sectors are in correction territory right now. Financials and regional banks both down more than 10% for the week. Our traders will break down the struggling sector next.
Why is Old Dominion #1 in customer satisfaction? Maybe it's our over 99% on-time rate, or how we support the dynamic digital marketplace. Our people never stop working to make your shipping easier. Old Dominion, helping the world keep promises.
No one likes to feel stuck, boxed in, or held back, especially by something like your cloud. It's a problem, but the IBM Cloud is different. It's the most open and secure public cloud for business. It can manage all your apps and data anywhere, so it can help take on anything, from rebooking flights on the fly to restocking shelves on demand, without getting in your way.
Grubhub and No Kid Hungry are feeding the 1 in 7 kids who live with hunger.
Join us, round up your change, and donate with every Grubhub order. Order and donate today.
Through the AT&T network, edge-to-edge intelligence gives you the power to see every corner of your growing business. From using feedback to innovate, to introducing products faster, to managing website inventory and network bandwidth, giving you a nice big edge over your competition. That's the power of edge-to-edge intelligence.
You should be mad at leaf blowers. You should be mad your neighbor always wants to hang out. And you should be mad your smart fridge is unnecessarily complicated. Making ice. But you're not mad because you have E-Trade, which isn't complicated. Their tools make trading quicker and simpler so you can take on the markets with confidence. Don't get mad. Get E-Trade and start trading commission-free today.
Zoe's extraordinary playlist is too good to be true. It's exquisitely crafted with a truly delightful cast. Critics say they can't wait for more.
Why are you acting weird?
Zoe's Extraordinary Playlist, Sunday on NBC.
Welcome back. Another steep market sell-off today. At the lows, the Dow is down more than 1,000 points. We're down 800 right now. That's a 3% drop. Relatively better picture for the NASDAQ, which is down less than 2% here. Still at 8,400 on the nose. We're talking about 4,000 point drop or so for the Dow so far this week. So the selling pressure does just keep going. Steve Leisman has some breaking news for us. Steve, what's happening?
Federal Reserve Jay Powell out with a statement now saying the Fed will use all our tools and act as appropriate to support the economy. I can read you the full statement here, which says the fundamentals of the U.S. economy remain strong. However, the coronavirus poses evolving risk to the outlook, evolving risk to the economic activity. The Federal Reserve is closely monitoring developments and their implications for the economic outlook. We will use our tools and act as appropriate to support the economy. An unusual statement issued, I would suspect, quite specifically while the market remains open, suggesting that the Federal Reserve could act and use all their tools and act as appropriate. Kelly?
And look at the bounce in the market right there, Steve, from 800 and some down 30 seconds ago, now down 639. So obviously there was a message received by the market in what you just said.
I'm not surprised that Fed Chair Powell spoke. Suspected he might have spoken sometime all week, or at least sort of towards the latter part of the week with the market downdraft. I think it tells you that the Fed is paying attention, aware of the potential risks, aware of where the market is trading. And I think hearing the market and the discussion that we just had about what the market's pricing in, we were at a 50 percentage point probability of a 50 basis point rate cut in March. We just had B of A call for 50 basis point rate cut. All of this leaves open what the Fed will do, when it will do it, but it certainly raises the possibility, or it brings the Fed closer to where the market is in pricing in some action by the central bank.
Steve, real quickly, are we to just say it's a coincidence that first we have Bank of America come out and kind of call for this half-point cut? All of a sudden, the market is kind of pushing on the Fed more for some action. Now we have the statement from the Fed where they effectively would, I don't want to oversell it, but they open the door towards action, don't you think?
Oh, most certainly. This statement does open the door to action. Look, this is a process that happens often. The asset markets move quickly, violently, and price things in. And then it takes sometimes the economists and the guys who watch the Fed to be brought along with that. That's what I consider the importance of the B of A. And I know the Fed, because of the interview I just did with Clarida, says, you know what? I look at the markets, but I also look at what the surveys of economists did. And it was earlier or later last week where Rich Clarett, the Fed vice chairman, said, hey, the economists aren't calling for one. And that was the importance of the B of A announcement. They're now on board with the possibility of a 50 basis point rate cut. I suspect others will be as well. Certainly the market was pricing that in, and now it seems like those who maybe spend a little more time considering Fed action, and certainly, as you suggest, Kelly, this statement by Fed Chair Jay Powell does open the door for some type of action. I don't think it suggests an action before the meeting, but as Bank of America said in its statement, it cannot rule out some kind of emergency cut, depending upon how the market reacts here and what further happens in next week, perhaps.
Yeah, very, very well put. Steve, stick around. We're going to also bring Ron Insana into this conversation and Kathy Lean from BK Asset Management. Ron, I'm trying to think about the last time we've had statements like this from the Fed. It's very rare for them to weigh in at all in this manner and when it comes to financial markets, or certainly to follow up with any kind of inter-meeting rate cut.
So I think, in one sense, it was the European Central Bank that said it was going to do whatever it took during the European sovereign debt crisis in 2011, where you got that type of statement that says, listen, we're here to solve a problem. You go back farther, obviously, during the financial crisis of 2008, and then again go back even farther to 1997 and 1998 when the Fed stood in for the Asian currency crisis, the Russian debt crisis, and not only made statements but ultimately moved. And it's interesting to see that the market thus far has not responded terribly dramatically to that news. The Dow, in fact, at one point while Steve was talking, was back down 700 points. So it does also speak to something that Steve was talking about earlier today, which is this a salve just for the markets, and will it address any issues that a widening coronavirus spread might bring to the U.S. and global economy?
And or, Kathy, is it a little bit of disappointment that it's just talk and not action at this point?
I think it's exactly that. While the Fed is very intentional in their comments, and as Steve mentioned, there's definitely a purpose to making this statement during the market open. At the same time, they needed to do this. They needed to say something against such a significant drop in the equity markets. With 4,000 points lost in 1 week, more could follow if nothing's done. There was some speculation that there could be some type of action taken this weekend. And I think by releasing this statement, perhaps they're preempting that and buying themselves some time until the March meeting. I think, for the most part, everything we've heard from U.S. policymakers is that they still think it's a little premature, and they want to see more evidence of the U.S. economy feeling that pain before actually taking action. And I think what, investors really want, as evidenced by the movement of stocks, is fiscal support, something from President Trump, something from Congress that actually would put money into their hands, like what some of the other countries around the world is doing, something with a little bit more immediate effect on their bottom line. They don't necessarily feel that, an interest rate cut, which the market's already priced in up to 4 now, will be enough.
And if I may, I'm not even sure fiscal policy response at this point would help either. I think what would help is a coherent public health policy response, which we have not yet gotten from this administration. And I think there's some people who have criticized putting Mike Pence in charge, given how he handled the infectious disease outbreak.
But even if they came out, Ron, and said, so you have on the one hand this statement from the Fed, what if the news instead had been, hey, we're going to now have daily briefings to, by the
like
CDC
Mexico.
and right, what have you, to kind of tell everybody here's exactly what's happening with the case count in this country. Would some measure like that you think do more to instill confidence than this statement from the Fed?
Well, yes, and in contrast to what we're getting, which is Mick Mulvaney this morning blaming the media for inflaming a situation that is actually real. The media did not infect 87,000 people, nor kill 2,000. It didn't put Japan and Hong Kong in a state of emergency and close their schools. It didn't disrupt supply chains around the world. It, did not track 8,400 people in California or quarantine 1,000 in Germany. These are facts that we have brought out, nor have we told people to sell stocks as a consequence. So when they keep saying, look, this is a plot to hurt the president, this is a very real event that's going to have consequences for some period of time, the duration of which we don't know. But it's not like we're making this up as a political ploy to harm a president. This is happening in real time around the world and having an economic impact.
And we certainly, I have to speak for CNBC here, we certainly did cover the travel restrictions that the administration promulgated about a month or so ago. And we covered it very, very, I think, thoroughly and responsibly at that point when they happened. And maybe we are not in as bad shape as we could have been because of those travel restrictions and the quarantining that we did. Kathy, are we at a point of such crisis that we really need to take fiscal action here and, as you say, put dollars in people's pockets?
Well, it would be the perfect excuse for the administration to do so. I think we're not necessarily at a point where that is necessary because the number of cases, regardless of whether you believe it's a true number of cases, in the U.S. is limited. And so far, U.S. data hasn't been terrible. Yes, earnings are going to be ugly this upcoming season. But I think that all the central banks, they really want to wait for the evidence. Now, with that said, though, President Trump, as part of his re-election campaign, has been pushing, for some sort of fiscal stimulus that would put money into the hands of Americans. And I think that the coronavirus situation, on the bottom line for businesses, I think bare minimum, this gives them an excuse to take some additional action. We've seen it abroad. Hong Kong has offered, cash 10,000 Hong Kong dollar payout to all of their permanent residents. In South Korea, they're offering rental subsidies for businesses along with temporary tax breaks on autos. So all around the world, we're starting to see fiscal stimulus. So while it may not be the permanent solve, and of course, a vaccine would be, much more meaningful, I think it certainly could stem the slide and the bleed. It needs to be an action that governments take eventually.
And the irony here, Ron, is that in order for the Fed to do as much as the market wants right now, or even more, like Steve was saying earlier, at this point, they'd have to do quite a lot. I mean, there's 3 rate cuts priced in. People are starting to talk
actually
about
now.
4 now, right? With the way things are dropping. You have to wonder if there's anything they could do that would really calm things down relative to some of either the fiscal things that Kathy's describing or, an announcement could hit the wires about better progress on a vaccine or a treatment and do a lot to calm people down as well.
Yeah, I mean, look, certainly the Fed could effectively put a floor under the slide in equities by cutting interest rates because then you allow for price earnings ratios and other valuations to re-expand, assuming that we're not going to see negative growth in China, assuming that we're not going to see a drawdown in U.S. GDP, and as Goldman Sachs suggested earlier this week, zero profit growth among U.S. corporations. So if you lower interest rates, you make the stock market slightly more attractive in those terms. But again, it doesn't go to the root of the problem that we're dealing with here, which is how much economic activity has been disrupted and for how long will it last. Yes, the Fed can help out in a manner of speaking, but again, it's not the solution to this particular problem.
Ron, thank you very much. Kathy, we thank you. And Steve, we thank you as well. Well, American companies of all shapes and sizes are prepping to deal with the coronavirus outbreak. And let's check in with someone who gave us a pretty good idea of what to expect in China when he joined us a few weeks ago on Power Lunch. He's Dennis Unkovic, an international attorney who specializes in mergers and acquisitions. And he has been speaking with businesses in China and across the world. Dennis, welcome back. What are you hearing from China? You pointed to the real danger zone business-wise in China was not the large state-owned enterprises, but it was the smaller and medium-sized businesses that don't have the cash flow or the capital bulwark against this virus.
That's right. Thank you for having me back, Tyler. What I've learned is that the small companies are increasingly in serious situations. The Chinese government 2 days ago, I guess it was Tuesday, they announced a 500 billion renminbi, which is, I guess, about 72 billion US dollars, that they're offering to small and medium-sized businesses to refinance their debt. And you were talking in the last segment about whether or not fiscal policy will help. Well, the Chinese are obviously extremely worried about that. Otherwise, why would they say, we're going to extend your loans, we're going to refinance you? Because the biggest problem in China is unemployment. If these small companies go out of business, aside from them not doing business, the Chinese government is faced with a populace that is increasingly unemployed. And that's something that a centrally controlled economy like theirs simply cannot accept.
As you look around the globe, I would think that there would be similar movements afoot in other countries, particularly Italy, potentially, where the economy must be slowing. You must be hearing similar things there.
Well, I had a talk just a few minutes ago with a client of mine in Italy near Milan. And what he said to me is the coronavirus at this point seems to be contained to the few cities. But he said the real challenge for him and for Italy is their recreational, their tourism. Italy is the 8th largest economy in the world, ahead of Russia and Canada. And at $2 trillion, 13% of their economy is now related to tourism. I spoke to someone earlier today who told me that in Venice, which is really not in the part of Italy which is being affected by the coronavirus, that the hotels there have experienced a 40% cancellation rate. And if you take that and you put it across Italy, and as you know, most of Europe goes south rather than north during the summer season, Italy could be very badly hurt. Their economy, as you know, is not particularly strong, so this could be a very serious thing.
As you look at China, how quickly do you think it could bounce back? In other words, you've had an economy that has basically gone to zero in this first quarter so far. It largely stopped. How quickly could it bounce back?
I don't think it can bounce back as quickly as we would like. Let me give you an example. Whenever they have their New Year's celebration, workers leave and they go back to their homes. Normally, about 80% of them return, and then they have to hire new workers. This year, from what I understand, instead of the 15 to 20% not coming back, now it's more like 40%. I know of one company in southern China that I can't disclose. They have about 1,400 employees. Normally, they would lose 200, 250. This year, they're down to 850. But the interesting thing is only 650 of the people who have come back worked for them before. So they had to hire another 250 people. The problem in supply chain is two things. First of all, productivity, which is down. You have to retrain the people. And secondly, quality. Mm-hmm. So I think that it's going to be a longer road for the Chinese to come back. I'm not optimistic.
Dennis, thank you. On that note, we leave it. Dennis Unkovic, we appreciate it.
Thank you very much.
And look at the market. The Dow is making a comebacks of some size. The Dow is down about 530 points. Before you got that statement from the Fed just about 15 minutes ago, we were down closer to almost 900 points. So again, markets continuing to try to figure out what this language from the central bank means and what further action might be coming. Now, as contagion fears do hit the market, some investors are starting to bet on plague stocks that could hold up in this market meltdown. Kate Rooney has more on that. Kate?
Hi, Kelly. Those millennial traders we saw rushing into Virgin Galactic last week are moving on to stocks that could benefit from coronavirus. Virgin Galactic now seeing net selling on SoFi's investing platform. The startup telling me its majority millennial traders are now buying, quote, plague stocks, or names that could benefit from this outbreak. It's a lot of smaller, small cap biotech names. Take a look. Drug developer Moderna saw 100 times its normal buying activity. Vera Biotech, 50 times the average. Lakeland Industries, a protective clothing provider, is also on the list, as well as Co-Diagnostics, which soared on hopes of a coronavirus test just this week. Also spoke to E-Trade, Charles Schwab, and Robinhood. Schwab's data is mostly in line with broader market trends. They saw some selling of tech and consumer discretionary. E-Trade saw a significant increase in volume and a, quote, buy the dip mentality in names like Ford and AMD this week. And Robinhood traders are still all about Virgin Galactic. That's the most bought and most sold name on the platform. SoFi, though, really seeing some new interest in those smaller biotech names. Guys?
All right, thank you very much, Kate. We appreciate it. Let's give biotech a checkup, as it has been one of the better performing sectors during this week's historic sell-off, down only around 9%. Joining us now is Michael Yee, Managing Director at Jefferies. Michael, welcome. Good to have you with us. There is, I think, one stock, Regeneron, is the only one, as of a couple of hours ago, to be positive for the week. That is because, I take it, they have a promising antiviral.
Regeneron is up. They've had not only some positive data around some of their core business, around an eye drug and some of the competition, but in general, there has been a huge interest in a lot of the antiviral names, like you mentioned, Gilead also being another one. So there is, like you said, a peaked interest in some of these biotech stocks.
Where do you think they go from here? Obviously, Regeneron up to almost 3% for the week, as we see there. Maybe that was just a day I didn't see. But at any rate, where do you think these biotech stocks can go from here, and will they be a bulwark in the market?
Well, I think there's two parts of that. One is that I've been talking about how this sector in general has been a tough sector, particularly the big cap names, Gilead, Biogen, Amgen, et cetera. And we believe that that's mostly been not only on drug pricing and political fears, but a lot of other factors going on. And so the two factors, one is let's see what happens with the coronavirus. And number two, let's see what happens next week with the Super Tuesday elections and all of the other things going on. Mm-hmm. Our view is the group is going to probably move higher, both on resolution in time on the coronavirus and these stocks are cheap, but also because, I know a separate topic, we believe the political fears and uncertainties are also going to resolve too. So that's a whole other factor that's driving this group.
And putting that aside, Michael, for now, I just want to circle back to some of the supply chain issues. You know, obviously people think biotechs could benefit on the demand side with new treatments, but what about the supply chain and the shocking numbers about the amount of drugs that are imported into this country from China? And what about just the kind of components to those drugs that a lot of your companies might rely on?
Yeah, that's great. I have actually reached out to Gilead, Biogen, Amgen, Vertex, a lot of my companies. Just want to be clear, a lot of the drugs that are coming in either as generics or otherwise are impacting more of the generic companies, sort of the big biotechs, big pharma, most of the traditional biotech companies. Most of those companies really not impacted by the supply chain out of China. Most of those companies' drugs or these cancer drugs are made here in the U.S. or otherwise, have not seen impact there. So for the most part, I'm not too concerned about that. And most of my companies came back and said at this point, while watching the situation, have not seen an issue there. So I'm comfortable there so far.
Does that mean that, for the most part, we don't have to worry about any disruptions to the medical supply chain? You know, we were talking to a gentleman the other day who works with sort of supply chain and container issues, and he's based out of New Jersey, but he was saying even things like, you know, insulin or different things that people might need could get held up a little bit just because there's, you know, not the right containers in the right places in this country for a variety of different reasons. Yeah. Any hiccups like that we should anticipate, or do you think this should all function pretty smoothly?
Well, look, I think no different than a lot of the supply chains in a lot of these other sectors we're talking about, of course, healthcare being pretty important here, is related to the fact that we don't know how long this is going to go on. I think in the short to medium term, again, having reached out to many of my companies, most of these folks have some sort of either built up inventory or built up supply of all of these products needed for supply chain, particularly because they're prepared for these types of situations. No different than when there was hurricanes in Puerto Rico, other sorts of situations like that. Most of them have these sort of contingency plans built into place. So I would think if we go out farther out in time here, we do need to start worrying about it. They're going to have to start looking at secondary suppliers. But for the most part here, I think it comes down to a bigger question we're all asking ourselves, which is how long is this going to go on? So faster the resolution, the less concern I have here.
Michael, thank you very much. Always clear. We appreciate it.
Thank you, guys.
Meanwhile, tech stocks getting crushed this week. The FANGs down double digits. And the trillion-dollar mega stocks like Microsoft, Apple, Amazon, Alphabet, losing nearly $1 trillion in market value this week alone. We've got much more on the markets coming up on this turbulent day on Power Lunch.
Plan to retire, plan to live. An annuity helps cover your essential monthly expenses, so you're free to live the life you want. Find out how an annuity can give you lifetime income at protectedincome.org.
At Fidelity, online U.S. stocks and ETFs are commission-free. And when you open a new brokerage account, your cash is automatically invested at a great rate. That's why Fidelity leads the industry in value, while our competition continues to talk.
Whether you've enjoyed the legendary terrain in Telluride, the unparalleled landscape of Park City, or the famed peaks of Whistler, you face the hassle of lugging your gear through the airport. With ShipSkis, you're just a few clicks away from having your skis, snowboard, and luggage shipped from your doorstep to your destination. With unrivaled pricing, real-time tracking, ShipSkis delivers hassle-free. Ship ahead and go catch those first tracks on fresh snow. ShipSkis, your skis delivered.
Read. Read yourself past the gossip mags, past the agendas, the bias, the partisan pandering. Read yourself better.
Hi, I'm Hanno. I created Gabi because most people overpay on car insurance. Gabi is a free tool that saves you money by finding the best deal. Gabi users save more than $800 per year on average. Go to Gabi.com and stop overpaying for car insurance.
Is your credit card debt stressing you out? Take control. A personal loan could help you get out of debt faster and save money. Credible helps you find actual pre-qualified rates from multiple lenders in just 3 minutes.
Visit Credible.com to see how much you could save.
These folks, they don't have time to go to the post office. They have businesses to grow, customers to care for, lives to get home to. They use Stamps.com. Print discounted postage for any letter, any package, anytime, right from your computer. All the amazing services of the post office, only cheaper. Get our special TV offer, a 4-week trial plus postage and a digital scale. Go to Stamps.com/try and never go to the post office again.
Welcome back. Stocks are having their worst week since the financial crisis, with the Dow on pace to lose about 4,000 points in the biggest weekly points drop ever. The Dow right now down about 2.3% or 582 points. The S&P a little bit less than that, 1.7%, and the Nasdaq only down 1%. Meanwhile, the yield on the 10-year hitting fresh record lows today, especially earlier today. You can see it there, the latest about 1.144%. So it does just continue to keep sliding. And Fed Chair Jay Powell putting out a statement just about 20 minutes ago saying the fundamentals of the U.S. economy remain strong. But, and this is where investors pay attention, he says the Fed is closely monitoring the coronavirus situation and will act appropriately. Let's bring in Lee Munson, Chief Investment Officer with Portfolio Asset Management, and rejoining us is CNBC contributor Ron Insana. Ron, you were with us when this Fed statement crossed about a half an hour ago. The initial market reaction looked either disappointed or unbothered completely by it. Now it might look a little bit better, but perhaps we're parsing this too finely here.
Well, and it's hard to tell, Kelly. You know, I think in a strange sense, going back to my earlier days of covering stuff like this, if the Fed had come out after the close, they would have set up Monday as a day in which the market could rally. And this is really kind of tactical stuff from a policy perspective. Whereas now, if the market sells off into the close after the Fed said something like that,
they've already wasted that bullet.
They've wasted that bullet, and there'd be a belief that, and maybe rightly so, that a rate cut is not going to cure this problem.
If they had done it after the close, would that have just given people all weekend to make the same arguments that we were making in
possibly? Yeah,
3 minutes time about whether it was enough?
It is a double-edged sword, and the Fed will get either praise or blame for just about anything they do at this juncture. But the fundamental issue is again still not monetary policy. It's how deep is the economic impact in China, globally, and here in the United States. How much does it reduce corporate profits in the first 2 quarters of the year? And would lower rates cushion any kind of blow you might see from the economic and business impact?
Lee, you want to weigh in on that?
Yeah, I do. I've been doing this for 22 years. And last night, I really felt a change of heart that I hadn't felt since September 2008 when Lehman failed. I'm generally a person who likes to come in early on corrections. We've been buyers of the S&P, a little bit emerging markets all week. But once I started looking at the information from the CDC, and also I've got a lot of clients, we're out here in New Mexico, and I have clients that work at the labs that work in risk assessment and nuclear deterrence. And what I'm hearing on that side is that we're going to get some more information in the next couple of days from the CDC. But the bottom line is, in order for this administration to get elected again, if that's their intention, they're going to have to control behavior. And when I hear that, I'm not concerned about death tolls. I'm not concerned about this going past summer. What I'm concerned about is that we're going to have school closures here. And if that starts to mute consumer spending, let's be honest. The U.S. consumer, it's what's keeping this global thing going. And even if hours get cut, it's going to be a problem. So I am not usually buying. I'm usually buying today, and I'm not today.
So let me ask you, even if we play out that kind of worst case scenario, take it to its logical conclusion. So there's school closures, there's event cancellations. This lasts for a period of some time. How are we talking about an actual recession? If so, how deep? And if so, how long? Because all of those pieces of speculation factor into what the market will do. There's a big difference between, hey, this is going to be slower growth for a little while, and this is going to be a sharper downturn, and the nature of a rebound that we might then get following it, whatever that rebound might look like.
Oh, yeah. I mean, all this week I've been spouting out a V-shaped recovery. So I'm not, by the way, I am still a bull. So let's just make sure that auto bull got told. But what I do think is I think the psychological toll is going to be much greater than necessarily the economic toll. I don't think that we're going to be in a recession. I don't think we're going to see more than maybe 15, 20, maybe 25% profits not coming in as we expected. But if you just have several months where there's less activity, people are going or not going out to eat and doing that, I think the psychological toll means that as we get closer to a 20% correction, which is only about another 100, 150 points from here, I think we go lower. More specifically, for all those technicians out there, we never got a retest of that December Christmas Eve 2018 low at 2350. I think that we're going to see a retest that would just move us back 14 months. But the bottom line is I don't see a severe recession, but I see a very much more severe reaction over the coming months. And that's why this bull wants to reduce some exposure in Europe, in Japan. But I'm not selling my S&P, but I am selling some small cap values, some other places. I'm doing silly things like buying some gold and short-term treasuries right now. I haven't done that since Lehman, and I think that's significant to have that type of change of heart just in 24 hours.
Ron, what I guess it's debatable what a rate cut would do for the economy. What would it do for the stock market and for oil?
Again, one would assume, and for all intents and purposes, Jay Powell just hinted that if necessary, the Fed will cut rates, and we've had virtually no response, meaningful response from the equity market. It's not like at the moment we're not looking at a rally that is going to take us higher at the close. Where I would part ways, I think, with Lee is that, look, 2008 was a unique event insofar as it was a global systemic financial crisis. That's not what we have. Banks have capital, they have liquidity. This is not a money problem of sorts. It is an economic disruption. And yeah, I agree, we might have a 2, 3, 6 month constraint on profits and growth, but we're in a year in which we're likely only to grow 2 or 2.5% anyway. So it's not like you're going to get some 5% updraft on the other side. Not here, not in China, not in Germany, not in Italy, not in Japan, not in South Korea. Japan, in fact, even before coronavirus, had a 6% contraction in its economy for putting on a national sales tax when the economy wasn't that strong. So I think you get, a longer period of slower growth. Even if you don't get a recession.
Real quickly, what do you make? We are seeing the dollar slide a little bit since Powell spoke. Treasury yields are falling, and that's helping kind of just shore up a teensy bit the action in gold and in some of the commodity. Is that more significant to you in the days ahead, do you think, or no?
Well, I think gold has been hurt by forced selling because, again, if there are margin calls and other levered players who are trying to raise cash, gold's been up a lot, so they may be taking profits there. What strikes me more is a 114 print on the 10-year note. The note continues to fall in yield even as the stock market tries to recover. So clearly now they're pricing in a rate cut. Now they're pricing in slower growth even more dramatically than they had earlier in the day. So, that's not my favorite message out of the markets right now with bond yields continuing to fall. That tells me, and with oil dropping still, that there's demand destruction expected ahead.
All right, Ron Insana and Lee Munson, thank you both.
The last hour is upon us, Kelly.
I know. I'm looking at you. You are the face of this whole story, Ty. It's going to be again tonight.
Yeah, we'll be on a special at 7 o'clock. I hope you all will watch, and have a good weekend, everybody. Close the bell right now.
Welcome to the closing bell, everyone. Coming to you live from the floor of the New York Stock Exchange. I'm Wilfred Frost. Major averages poised to turn in their worst week since the financial crisis. I've come to the Delta Post today. Airlines tanking this week. Delta down 4.5% today, down over 20% just this week. The S&P 500 down 2% right now today, down 12.5% for the week. 59 minutes left of this session.
Welcome, everyone. I'm Sarah Eisen. We are all over the market sell-off with a big lineup of guests for you to help you navigate the volatility, including Galaxy Digital's Michael Novogratz, Eurasia Group's Ian Bremer, JP Morgan Asset Management's Gabriela Santos, and many more. Let's look at what is driving the action now with the Dow down almost 700 points again. Coronavirus fears sending the market plunging, the Dow falling at one point more than 1,000 points at session lows. All 11 S&P sectors are tumbling, though, into correction territory, meaning 10% off their highs. Stocks are off the worst levels of the session, though, after Fed Chair Jay Powell came out with a statement saying the fundamentals of the U.S. economy remain strong and bond yields are plunging again, sending mortgage rates to their lowest levels in 8 years. Joining us for the hour, the final hour of trade, is Lindsay Bell from Ally Invest, which has $7.85 billion in total net customer assets. Also with us is CNBC senior markets commentator Mike Santoli, as always, to take you through the bell. Though, Lindsay, what are you getting from some of your clients, and what are you telling them?
Our clients are retail clients, so they are definitely concerned. So we're telling them, first and foremost, please do not panic. This is why you should have an investing plan in place. And always go back to that plan to reassess where you are and where you want to be and what the timeline is to your financial goals. Because remember, we've been through 5 different corrections in this bull market. This has happened to us before, and on average, it takes about 5 months to get back to break even.
So you're telling them to stay in the market?
Yes, right now.
As long as they have a longer horizon, then what?
Then 5 years. You know, if you need the cash before 5 years, you should be thinking about putting your money somewhere else besides the equity markets.
Mike? Jay Powell out with a statement. I can't remember last time that happened. I think it's pretty unusual.
It is unusual for sure. Normally, the Fed's going to filter out a little bit of a change in stance through either formal speeches or comments, public events, things like that. So this obviously is a response to the overwhelming expectation by the market that there would be some kind of response. If you look at the way the bond market is postured right now, it's already pricing in a sure thing of a March rate cut, and you have all kinds of talk about some kind of coordinated weekend response, whether that's just kind of a statement or something else from central bankers. So I do think it makes sense. Also tactically, probably well timed, because there was the danger of things getting messy into a Friday close, perhaps. Now, that being said, it doesn't really say to the market anything the market wasn't already assuming, which is acting as appropriate, which is code for we are ready to ease policy in some way if things go the way we want.
And it's not having a humongous effect.
No, it hasn't had a huge effect on equity markets, maybe a momentarily bounce and now down again. And yields, in fact, push lower still, which clearly has not supported equities when that's happened.
Well, I would just add that the timing is very interesting, too, because you're going into tonight and we're going to get that China manufacturing data, right? So that could be a disaster.
But everyone expects that, don't they?
I know, but these guys are just coming in and saying we're going to be here to support if it does, in fact, turn out worse than expected.
We've got full team coverage of the turmoil on Wall Street. Bob Pisani is on the floor with what's driving the drop. Bertha Coombs at the NASDAQ. Wilfred has an inside look at what traders are saying at the top desks. Mike has his market dashboard, as always, and Meg Terrell joins us with the latest on this deadly outbreak. Though, Bob, first to you here on the floor.
We're looking for signs of exhaustion, signs of capitulation. Not quite there yet, but a lot of them say buy. So take a look at the S&P. Powell's comments were good for about 30 points on the S&P, believe it or not. That would have been a huge rally on any other day, but today he did specify they would act as appropriate to support the economy. Again, you see us drifting a little lower, so it's not clear this is going to be enough really to turn the tide. You're looking for signs of seller exhaustion. You want to look at some of the big names in the last few weeks that have been trading heavily. Encouraging to see Exxon at least finally positive. Some other names like Dow and some of the transports like FedEx and Ryder holding up a little bit better today. That's at least some signs that the selling has stopped for the moment. Not everywhere, though. You look at the banks, not surprisingly here, maybe with, as Wilfred mentioned, the yield's still sinking. J.P. Morgan's doing nothing. None of the banks are doing anything, and J.P. Morgan down, along with most of the big regional banks, about 15% this week. We'll see how the close goes. Remember, guys, we've had a lot of margin calls in the last day or two after about 1:30, and you can see the pressure on the markets, the drooping there. Guys, back to you.
Bob, thanks so much for that. Let's get to Bertha Coombs at the NASDAQ for a look at the biggest movers there. Bertha.
Well, unlike Wednesday's bounce back here at the NASDAQ, the strength today is much more selective. Microsoft is the best performer of the mega caps, but it's still down nearly 11% for the week, which will put it on pace for its worst weekly loss since 2006. Apple, meantime, has had a hard time rallying today, looking at its worst week in nearly 20 years. And not much love for Amazon or Alphabet, which have been beaten down hard and are now both below that $1 trillion market cap level. The semiconductor sector has provided a bit of strength today, but here we see it dipping in the red as we head towards a close. A lot of these names, even with today's rally, are off between 15 and as much as 40% from their highs. Xilinx, in fact, hitting a new low before rallying today. That one's down about 42% from its 2019 high. Wilf?
Bertha, thanks so much for that. Now, I've spoken to the head of trading at one of the biggest investment banks in the world, the U.S. investment bank, just about an hour ago. And here are their main takeaways in terms of what's been happening so far this week. First of all, that client flows remain reasonably two-way, i.e. not all one-way traffic. Markets have moved a lot, yes, but still functioning well and doesn't therefore feel like 2008. Also, most of the selling they're saying is coming from systematic quant funds. True that hedge funds and mutual funds are also not ready to try and catch the falling knife and buy, but they and retail investors are not responsible for most of the selling we've seen this past week. Now, I asked what they are looking out for that would make them think that it is more like 2008. And the first thing they said is retail money. Estimated that about $20 billion of US ETF liquidation has taken part this week, most of which probably is retail investors, but that is not huge in the grand scheme of things. If more comes, that would be a worry. Second, keep an eye on central banks. We just heard from one, of course, not just rates, but the need to make sure the repo markets, liquidity continue to hold up and that they have the tools to ensure that that happens. Finally, keep an eye on the fundamentals. Do we see things like schools shut down, stadiums empty in Europe and the US? If we do, it's a concern because of what that will do to confidence and then GDP in turn. But just in closing, even if we escape that doomsday scenario, which is currently their base case, they don't expect a V-shaped bounce because of the huge gains we saw last year without necessarily huge incremental amounts of good news. So what I'd sort of summarize of saying is, the bear case here is there's quite a lot of money still that could come into this in terms of selling, like retail investors. The bull case is that markets have actually functioned very, very well. Headlines like, is this a repeat of the financial crisis? Well, the market is not saying that yet. It's functioning well. There's two sides of every trade. We're not legging down.
I also find it interesting that when you ask what they're looking for as far as catalysts, that central banks were among them. Some sort of action is really anticipated.
Right, and the point being is things like liquidity, the repo market, which we often focus on, that this isn't just a case of interest rate cuts where some central banks have no room. It's a case of just making sure those things are functioning and moving so you don't get a shortage of liquidity on trades.
I think that one of the key questions that comes out of that, Lindsay, is retail next? I mean, if the trading is really being driven by quants and algos and that sort of thing, how much of a wave of money is retail going to pull, if at all, from the market after?
Well, I can tell you at Ally Invest, our volumes have been up extreme this week. They're at the highest levels that we've ever seen. So the retail investor is being very active in this down market. I don't have the data on buying versus selling. My guess would be there's probably more selling because we have heard our voice of customer getting nervous. And we're, like I said at the start of the show, we're telling them to not panic in this situation right now. So we are seeing the volumes as well.
S&P on pace for its worst week since the financial crisis. Mike Santoli is looking at how that time, the financial crisis, does differ from today, and this is important.
Yeah, the context, Sarah, the reason we're talking about the parallels is because the equity market dynamics in this 1 week concentrated period have to go back in some respects to 2008. But when in 2008? We're comparing back to mostly after the Lehman Brothers shock in September and fall of that year when we really saw this cascade lower. But what was going on beforehand? Well, let me tell you, the market peaked in October of 2007, nearly a year earlier. It was already down 20% in this very kind of managed bear market fashion. Then we got the shock, and we were already a year into a recession, and it was not really a stock market issue. It was mostly dislocations in the mortgage market, in credit. Those were the liquidity issues. The stock market was kind of the tail and not the dog. Now, look at that compared to the current chart over the last couple of years. And what you see, obviously, is this was a vertical drop off of an all-time high in a bull market, which has been a bull market for a while, very similar to this one and this one. And so it's not really happening under the same dynamics. I do think the comprehensive washout type selling does look like 2011, does look like some parts of 2015, and yes, 2008, and even some of these washed out measures are going back to things like 2002, which is the bottom of a prior bear market. I just also want to show on the credit side, this is a chart of high yield corporate credit spreads since before the financial crisis. So we saw this little tiny peak up right here. This is junk bond spreads, the index. And you see this cycle has been obviously more gentle, but that was 2015, 2016. That was the scare back then when energy was crashing. I mean, this is Lehman right here. It doesn't bear any comparison in terms of what's going on either in the real economy or in the provision of credit in the banking system. It really is just about the equity market getting blasted in a very comprehensive way.
And Mike, I guess breaking that down just one level further, the key difference, therefore, is that in 2008, there were lots of question marks about many companies potentially going bust and many consumers, if they lost their homes, going bust. And that just doesn't apply at all at this stage.
Not at all. I mean, if you remember, at that point, GE wasn't going to be able to roll over its commercial paper, which was a AAA-rated company. It was unthinkable. Right now, this is a stock market correction, much like the 3 or 4 that we've had this cycle.
Mike, thanks so much for that. Let's get an update on the latest coronavirus developments. Meg Terrell's got the details. Hey, Meg.
Hey, Wilf. The World Health Organization raising its global risk assessment to its highest level today, citing concerning spread in an increasing number of countries. They note linked epidemics in several countries, but say most cases can still be traced to known contacts or clusters of cases, meaning they're not seeing the virus spreading freely in most communities. For that reason, they say there is still a chance of containing the virus if action is taken to detect, isolate, and care for patients early and to trace their contacts. And that's what's happening now in California around the patient who may be the first case in the U.S. of community transmission. The CDC saying this afternoon it may turn out the person was exposed to a returned traveler. They're working now to identify who came into contact with that patient, including family members and healthcare workers. Meanwhile, work forges ahead in the race for treatments and vaccines. The WHO saying today 20 vaccines are in development around the world, and several potential treatments are in clinical trials, with the first results expected in a few weeks. Guys?
Meg, as far as the number of cases in the U.S., obviously good news that we haven't heard those numbers go up. Although there are questions about whether the tests are effective, whether they're being used, whether they're readily available. What can you tell us about that?
Yeah, there are a lot of questions about whether we are, in fact, just not testing for cases that may be here. I think Dr. Michael Osterholm yesterday said the absence of evidence is not evidence of absence, making the argument that we should be testing more and therefore we may turn up more cases. However, the CDC saying today the reason the number of cases is so low is because the U.S. took such strong action at the borders back at the beginning of February. And so they are saying that they don't believe that there are more cases circulating here in the U.S. However, they are increasing testing capacity, and so we might start to see case numbers in the U.S. go up next week, guys. We're just going to have to wait and see.
Meg, as always, thank you so much. Now, if you're just joining us, another sea of red here on Wall Street. The Dow has lost more than 3,500 points so far this week. It's down 13.8% in percentage terms for the week, down 3% just today. There's the Dow 30 heat map for today. As you can see, just three of the stocks managing to eke out slight gains, but large declines elsewhere. JP Morgan at the bottom of the pile, down 6%. Coming up, we'll talk to Mike Novogratz, who ran the multi-billion-dollar macro fund at Fortress. We'll hit this week's sell-off and whether investors should buy the dip.
So we've got just about 45 minutes left to go in this session. Here's a check on some individual stock were active. It also issued weaker guidance. The stock down more than 12%. Meanwhile, shares of Beyond Meat falling again today on an earnings miss after the bell yesterday. Analysts are cautious on increased marketing expenses. That stock also down sharply 17%. Over the past 7 days, these six companies combined have lost $1 trillion in market cap. Apple losing the most over the past week, seeing a $263 billion hit to its value. But if you look at some of the other mega cap technology names, some of the most beloved darlings on Wall Street, yes, they're huge. But Mike, look at those declines and that loss of market value.
It was built up in a hurry, and it's been taken away in a hurry. I do think that when it comes to that segment of the market, it's obviously not at the center of the economic concerns or the health concerns. It really is about how people were positioned. And so you had a lot of big investors and really small investors, too, overcommitted to a narrow group of stocks in the market, and that's being unspooled.
The hurry, is that because of algos and systematic trading, or is that because this is a really panicky move?
It's probably some combination of the two things. This market does move faster. It reprices fast. But by the way, the same players and dynamics were why you've had all these streaks when we're going up of no 1% declines in 3 months, and the market grinds higher and volatility goes lower and lower. This is the flip side of that action.
Mike, in terms of the market's attempts to rally intraday, we've seen this multiple days this week. I mean, Apple's a great example. It went green for a moment today. It's now down again. Microsoft's holding on to a slight gain.
It's always going to be very twitchy, and you have positions under stress, and essentially people trying to anticipate the turn, but not having high conviction that we're at the turn, and so you try it doesn't work, and I think all that stuff comes into play. It's very typical of a market that's moved a long distance in a short period of time.
I would just note, Wilfred, that energy just popped positive in the S&P. Not used to seeing that, and certainly not used to seeing that as the only group that's positive, but it is.
It's flirted with it a couple of times today, and that's despite oil prices being down another 4%
well, it's
today.
The stuff that was just trashed, completely let us down into this.
Let's bring in Tony Pasquarello, who joins us now. He's global head of hedge fund client coverage at Goldman Sachs. Been on the trading floor, therefore, all week in the midst of this sell-off. Tony, good to see you. Thanks for joining us.
Thanks, Wolf. Good to be here.
So what do you think has been driving the selling, the key factor this week?
So if one could measure our client inquiry and incoming questions from our franchise, far and above at the top of the list is, of course, concerns around the virus. And I think we find investors and traders, they're used to confronting earnings volatility. They're used to confronting economic volatility, perhaps used to confronting some element of political volatility. Biological volatility is a very different variable. And so the questions of not only the human element, but really what is the knock-on impact to global growth is the answer our clients have been searching for.
If you look at the trade flow as well, how would you classify the bulk of who the seller is? We were discussing this earlier. Is it retail investors, mutual funds, hedge funds, automatic traders?
Very good question. So take a quick step back. It's been a remarkable run for asset markets for the past 11 years, certainly for the past 5 years. Just look at 2019. And so I think what you have is you have a community of investors, both retail and institutional, both systematic and discretionary, have accumulated risk. Rightly so. That served them very well up until last Wednesday. Now you're feeling a pinch. Now you're feeling, as Mike pointed out, the fastest 10% correction on record. So we're seeing bits of risk transfer and hedging, I'd say, from all corners of our franchise. Not one cohort sticks out really significantly from the rest.
Is it the type of fear levels now that have reached such a fever pitch that you might look for a bottom?
I would say this, Sarah. It hasn't felt like a panic. Our flow all week has been orderly. Clearly, just judging from volume, a lot of risk has transferred. I would say the tone of the trading floor has been measured. Markets have functioned well. The financing market, the credit market, the equity market. Nothing dysfunctional, no true dislocation. So do I feel like we've seen the kind of capitulation that may mark the dead low? Not necessarily. We may not see that.
And to that point, the liquidity has remained pretty good throughout, i.e. this is not like 2008?
The word choice I would use is functional, yes. And so as very distinct from 2008. 2008, fundamentally, as Mike pointed out, really was centered in a credit crisis. To this point, that's not what we're confronting. The liquidity dynamics, the ability of the financial system at large, again, financing markets, credit markets, clearly the bond market and the equity market have been able to manage the risk off.
And if you could compare it to a less extreme example, which would be the early part of 2018 when we saw that kind of volatility shock, similar kind of shape of the decline from an all-time high, how would you compare it in terms of the trading dynamics?
I think there's a few analogs I would point to. One would be 2011 in the context of will Greece leave the Eurozone, the U.S. debt downgrade. The second would have been the summer of 2015, August, dislocation in the Chinese financial markets. And the third would be the January into February period of 2018. They all feel really challenging when you're going through them. I think for us, the biggest judgment is always, number one, the Fed, and number two, the durability of U.S. growth. And so when the Fed is acting, we expect them to cut 3 times in the next 3 months. And when you can continue to believe in the durability of U.S. growth, then we think the big dynamics in the game are still good enough. And as we know, in the absence of recession, you typically do not confront bear markets. Not all the time. 2018 was a counterexample, but typically the history book is on your side in the absence of the recession. And so that's why this episode looks much more like those 3 episodes than 2008.
Tony, thanks for joining us.
Great to have me. Thank you.
And still to come on the show, Eurasia Group's Ian Bremmer will tell us why he thinks the coronavirus outbreak is by far the most important crisis the Trump administration has faced yet. He's joining us in the next hour. Time now, though, to get word on the street with 40 minutes left of trade. RBC out with a list of high conviction stock picks saying there are, quote, opportunities for quality at a reasonable price in a volatile market. It's a list of 29 stocks, and that includes Campbell, Duke Energy, Toll Brothers, CVS, and Visa. Jeffries saying for those with coronavirus concerns, machinery is your friend, and that, quote, thus far, machinery and industrials seem like a relatively safe haven. Deere is among one of the topics there.
Citigroup out with an optimistic note on Apple. The firm believes, quote, things are beginning to improve in China for Apple. Citi says that as production returns to normal, the firm expects investors to shift focus toward overall end market demand. The stock, though, of course, still down. I guess, Mike, we touched on this a moment ago. Lindsay, where do you stand on those big cap tech stocks like Apple and their sort of inability to really mount any kind of recovery?
Yeah, I mean, well, they were clearly the lead in taking us to new highs before the coronavirus really broke us down. And it was part of the complacency. These were easy names that people talk about. We talk about on the financial news all the time, right? So it was easy for the retail investors to really jump in on this trade and help drive it higher. I think that, of course, you're going to see the highest flyers fall the fastest in a moment like this. So we want to see these names really begin to stabilize and show some strength. Again, I will note today, you mentioned energy broke into the green just a moment ago. Technology broke into the green earlier today. So I think that you are seeing some buying in some of these beaten up sectors and names over the past.
I think the way you would typically see it happen is the stuff that's just been down the most and is essentially just been discarded, whether it's energy or the travel names or some of the stuff that's just really badly positioned structurally like autos. Now, if we get an all-clear type feeling in the market, they will go up the most percentage-wise, but for the sustainability of a rally, it's got to be the old leaders. The big growth stocks have not yet really broken their long-term trends, and they would probably have to kind of marshal a little bit of a comeback for the overall market to kind of have anything convincing.
Though technology is down, not as bad as the rest of the market.
That's what I'm saying.
Today.
Yeah, I mean, it's held up better. It's still leadership right now. As a matter of fact, the popular trade, long growth and quality and short value and, kind of high beta has actually still worked even in this downdraft.
Just say as well, for the broader markets, you're looking at it there. Now all the sectors are in the red. Again, energy, of course, as we mentioned, has been flirting with the green over the last hour or two. And it's, Mike, the market's really struggling to find its footing. Again, we've had 2 or 3 mini attempts in just the last 30 minutes to rally. And again, we're slipping again. We're not at the lows of the session, but we're down 750 on the down.
No, there's an undertow of, first of all, Fridays have been weak all year, even before we were in this tough zone. Once the market has shown an ability to just slice through all these levels that we thought were significant and not find buyers, at levels that, by the way, today we sliced below the January 2018 S&P level. Right now, I said yesterday, the S&P in the 2800s gets interesting because it dials us back to the late summer of last year, and it undoes this whole trade, this whole rally into the fourth quarter and beyond that said, the globe is going to reaccelerate. Back then, we were still in kind of a touch and go on recession, flat yield curve, and all the rest of it. So, in a sense, you've removed that entire stretch of economic optimism from stock price.
And Mike, just quickly to go back to those levels, the relevant levels of sell-offs, when we had the Christmas 2018 sell-off, how much lower is that than where we are now?
Well, we were down 20%, essentially high to low. So at the lows today, the S&P was down 15% from its high.
We're down 14.3% now from the high. Another note out today from research firm Benchmark. They have a buy rating on Ligand Pharmaceuticals, which ships an ingredient used in clinical studies of Gilead's drug Remdesivir, a potential coronavirus treatment. Joining us now in an exclusive interview is Ligand CEO John Higgins. John, welcome. Thank you for joining us.
Thank you.
Tell us a little bit about how you're involved with this drug that everyone in the world is watching.
Thank you. Happy to be here. There is a lot of attention, obviously, around the coronavirus and COVID-19, the developing story. Ligand is a company that provides technology, drug discovery technologies, and ingredients to help make drugs possible. We have one particular excipient called Captisol that helps stabilize or solubilize drugs. Many drug concepts are very good concepts, but the active ingredient isn't stable or it's insoluble. It's not available for absorption by the human body. In this case, with Remdesivir, it's a broad-acting antiviral that is highly insoluble. Tremendous efficacy. There's animal data across a variety of viral targets, some limited human data, but it's insoluble. So in this case, Gilead and now some other partners have contacted us. They're seeking supply of Captisol to help make their drug possible. This really just came on our radar the last 6 weeks or so. We've had extensive conversations, and now, per our announcement yesterday, we've realized some substantial orders to help service these partners as they build up capacity to run their clinical trials.
And John, how significant have these orders been so far, and how much more significant could they be if Remdesivir gets approved and used to treat coronavirus?
The announcement yesterday, we indicated that we've seen an additional 5 million of orders. That's several metric tons of quantity, and this is, we believe, just the beginning. Now, to put in context, our annual sales for Captisol across 70 different partners the last few years has been about 25 to 30 million annually. So just in the last couple of weeks, a couple of orders have come in for $5 million alone for this one antiviral agent for this particular market. Now, we're still in clinical development. Data won't be out for a few weeks. People are saying probably into April. These are still clinical trials. The Chinese government is running trials. The U.S. government, the NIH, is now running studies out of Nebraska. And Gilead just yesterday announced that they are opening up 2 1,000-patient trials. So these initial stockpiling orders are really to prepare the clinical supply, but now we are in dialogue. We know that there's interest for more Captisol. We do anticipate additional orders this year to help supply not only more clinical trials, but potentially preparation for broader use as a therapeutic to treat more severe patients with coronavirus.
What kind of time frame are you looking at? What's your expectation?
Well, with drug development, and first, I want to be clear, remdesivir, it's not our drug. We didn't invent the drug. Right. It's not our drug, and we aren't running the trials. We are going to comment on the outcome of those studies, but Ligand is prepared. We have substantial capacity. We manufacture out of multiple sites. We have a very stable source of supply of raw materials from markets that we do not feel threatened for distribution or trade disruption. And we are preparing now potential quantity for delivery to partners that could be substantial, well beyond what we've announced just yesterday. But again, it's a watch and wait mode. We really need to wait to see if there's clear clinical activity, safety and efficacy for this drug as a treatment. And we'll get that data probably in the next 3 to 6 weeks or so.
John Higgins, keep us posted. Thanks for joining us.
Lindsay, where do you stand on the healthcare and biotech in particular?
Well, I think healthcare is very interesting because it's one of the cheapest sectors within the market. And usually you do see it do well in uncertain times like this. Like from June to the end of 2018, healthcare was actually the only positive sector within the index. You're not seeing it move as much this time around, and that's probably because there is some weight related to the election and the sector on that. You've seen United Healthcare in particular really come under pressure with the rise of Bernie Sanders. So I think it's a tough sector, but I think you can be picky within it, and I think biotech is one of the areas that can do well.
I mean, how important do you think hearing from this man at Ligand, getting the updates from Gilead around the drug? Yeah. It seems like that would be a headline. Yes. The market would care a lot about.
No doubt about it. I mean, if there was anything that was very convincing that it could control or arrest the spread or treat, yes, obviously we're looking for something like that. I don't think the market is on pins and needles about it, but it absolutely would be
these things take time,
a positive.
A year and a half?
Just the sense, right. But just the sense that somehow we have our arms around it, that work is proceeding fast on those fronts.
We have 30 minutes left of the session. It's been a wild week, of course, for markets. The Dow dropping sharply each day this week. The worst decline being yesterday when we had a nearly 1,200-point decline. There are the individual point drops. And today, at the moment, we're down 900. Again, just an extra little bit of selling in the last 10 minutes or so. We're down 3.5% in percentage terms today, over 14% now for the week as a whole for the Dow. Every sector back in the red quite comfortably. We just mentioned how energy had been positive within the S&P. It's now down over 0.5% itself. The worst performing sector today as we stand is financials, down 4.5%. Of course, yields continue to collapse.
The yield picture is just crazy. 112 on the 10-year. That's not even the low of the session, which was 109.
Astonishing moves. Down 3.5%, 900 points on the Dow. Coming up, we'll have much more on this week's massive sell-off with former hedge fund manager Mike Novogratz. As we just said, 30 minutes or so, just under 29 minutes left of the session. Here are the key things driving the action. Coronavirus fears sending the market plunging. The Dow falling more than 1,000 points at session lows and getting close to those levels again. Fed Chair Jay Powell said the fundamentals of the U.S. economy remain strong, and oil and bond yields plunging, with oil turning in its worst week since 2008.
Let's get to Eamon Javers in Washington with some new commentary from lawmakers around coronavirus, Eamon.
Yeah, Sarah, that's right. Just to give you a sense of how the information flow is going here at the White House, I just ran into Senator Lindsey Graham of South Carolina here inside the West Wing, and he's about to fly with the president on Air Force One to rally in South Carolina. He told me that on that Air Force One flight, he's going to try to set up a conference call between the President of the United States and Tim Cook of Apple, because Lindsey Graham believes that Apple's got some of the best intelligence out there about what's going on the ground in China in terms of the virus, and also in terms of Apple's production, which facilities they're able to get up and running again, which ones they're not, and why. He said Tim Cook is one of the smartest resources out there, and he wants that private sector expertise to go straight to the President of the United States. So the president's leaving here in about an hour's time, and Lindsey Graham says he's going to try to patch him through to Tim Cook of Apple while they're on the plane on the way to that rally, guys. So an interesting sense of the private sector, public sector feedback loop here that's going on.
Interesting, Eamon, and no doubt Tim Cook, I'm sure, would have great insight on all sorts of things. I'm not quite sure why Lindsey Graham is needed to patch the two together. They have a relationship already.
Yeah, that's right. And Lindsey Graham is somebody who's a facilitator, though, and very close to the president. So I think if he wants to make that happen, he can make it happen. And Graham told me he also wants to hear from Tim Cook. He wants to know what Tim Cook has to say on all those issues.
I think Tim Cook's been saying, actually, that China's been looking a lot better and that the supply chain is doing better. Eamon, Washington Post is running a headline, White House weighing tax cuts to address coronavirus fallout. Have you heard anything about this?
You know, I saw that headline just cross the wires here a second ago. What I'd say about that is earlier today, somebody here told me that the president's getting a lot of input. A lot of ideas are coming across his desk today and yesterday in terms of what to do about the virus. And this person put it to me this way. A lot of people are pitching ideas to the president that are the ideas that they preferred anyway, and suggesting that, the thing I've always been advocating, now we should really do it because of the virus, right? So the president's in a position now where he's going to be sifting through a lot of these proposals that are coming across, deciding which ones are really appropriate for the virus and which ones are sort of people tacking their idea onto a virus train here, so to speak, and trying to get some stuff done on issues where they've already been active. So no indication of that to my reporting, but they are always talking about tax cuts here, and they have said they want to put together some kind of proposal by September called Tax Cuts 2.0, which will be more of a campaign document to go out on the campaign trail in the fall and talk about the reelect here and say that that's something they want to do in the second term.
Eamon Javers, Eamon, thank you. Dow down 861, Wilfred. Interesting that the hint of fiscal and now monetary stimulus is not doing anything to get these markets up. I mean, first Jay Powell and the Fed come out with a statement saying we'll use all our tools available. Mini bounce, not really getting it done. We have a headline here that the White House is weighing tax cuts. That too, not really getting anything done.
As we discussed, though, I think the bond market's already priced in these rate cuts, so it's not like the statement by Chair Powell was hugely incremental until we actually see them delivered. We've got a market flash on Constellation Brands. Rahel Solomon has the details. Hi, Rahel.
Hi, Wilf. So shares of Constellation Brands, of course, the owner of Corona Beer, are moving higher, although still in the red. So this is as the company disputes claims of the impact of the coronavirus on its Corona Beer, essentially putting out a press release saying that based on recent trends, sales of Corona Extra remain strong, with dollar sales up 5% in the U.S. per the latest 4-week period ended February 16th. The CEO of the company also saying that it's extremely unfortunate that recent misinformation about the impact of this virus on our business has been circulating in traditional and social media without further investigation or validation. Wolf and Sarah, you may have seen that reporting or those social media posts essentially saying that consumers would be less likely to consume Coronas because of the coronavirus. The company essentially saying that their trends show that that's simply not true. You can see shares of Constellation Brands are down about 3.4%. I'll send it back to you.
Rahel, thank you so much. Let's get over to Mike now for more on investor sentiment as things stand. Mike?
Yeah, well, so many ways to point to extremes in investor sentiment. It's rushed to a very negative, skeptical place. Just one of them right here, the Daily Sentiment Index. This is coming into today on the NASDAQ 100. Now, NASDAQ 100 down another 2% since this chart was made. But what you see here is bullishness in this survey. Daily Sentiment Index, again, was around 10. And if you want to look at previous times when we were somewhere in this zone, I'll point to them right here. And what you'll see is it's somewhere in the vicinity of when the market tries to stage some kind of a reflex rally, but it is not always really when the coast is cleared. So this in particular, October of 2018, we had a really big sell-off from early October that year. If you remember, high was in September, and people thought it was going to be like this, chopping sideways. We did have another down leg. So similarly, early 2018, and then obviously, I believe that's right, last year that we did get a pretty timely signal on this. So it just shows you the groundwork is being laid, super oversold. Most stocks are down a ton, and sentiment on a trading basis is very negative, although broader public sentiment probably has not had time to adjust. Obviously, it's going to depend on exactly how we get information on real economic fundamentals. It's not all about tactics and sentiment and technicals, but this does show you the groundwork for when the market probably, maybe early next week, is going to be primed to stage a rally from some level.
How do you translate that to retail investors, Lindsay?
Yeah, I mean, I think you're seeing a lot of different indicators showing that we could be poised for a temporary rebound at least, because to Mike's point, that chart shows you get down to these levels, you can get a bounce and you can go back down and to retest to confirm that if we can move higher or lower from here. I think, look, over 70% of the companies in the S&P 500 are in correction territory. The VIX reaching 49 today. That's an area where we can start to see the fear begin to shake out. It doesn't mean we're at a bottom, but it makes
high fear levels.
High fear levels, exactly. So it gives you an entry point, I think, at least into the market. Even if we do go lower, you kind of are legging your way into the market. I also think when you look at the move in gold, down 5% since it's high.
What's that about?
Since it's high on Monday, I think you're starting to see some signals. Even the action today, the energy sector, technology sectors that have been down so much in the last week, people are actually willing to buy into these. I think we're getting ready for at least a near-term bounce.
Because treasuries are the real gold.
Yeah.
That's why. Gold is nice to have, but only because at some point you want to redeem it for dollars if things get really bad.
A couple of other theories, though, on the gold one. One is that people want to find something that's up that they can sell to buy some of the stocks that's down.
So liquidation in general.
Liquidation in general, but also the possibility that we are now having a high level of confidence of some kind of Fed easing. And if you see that, then this wild card safe haven asset is less relevant if things are going to be stimulated.
In the dollar, yeah, sure.
But you're saying you'd rather see Treasury yields bounce than, or at least go up.
Yeah, I don't think gold is going to be really the timely signal of a turn, although it does make sense that it was very strong going into this phase. So to Will's point, you had profits in it, and so you're seeing a pullback.
Fed Chair Jay Powell putting out that statement last hour saying the fundamentals of the U.S. economy remain strong. Let's get to Steve Leisman for more. Steve, anything on the backstory of why this statement came out now?
Yes. Let me get to that in just a second. I do want to point out, Sarah, for your edification and information here, that while stocks look to have shrugged off Powell's surprise announcement, there has been a sizable move in the outlook for the Federal Reserve as priced in the Fed funds futures market. Take a look at this. I can truly say I've never seen anything like this before. There's now a 100% chance of a 25 basis point cut, but a 94% chance of a 50 basis point cut. That was not on the table a few days ago. It was in the 30s and the 40s and the 50s today. After Powell's statement, the market is baking in a 94% probability of a 50 basis point cut when the Fed meets in March. Just real quickly, you can see that a third cut is built in, if you call it a third 25 basis point cut, 68% probability for June, and even a fourth one as soon as November with a 52% probability. Just want to remind folks of what Powell said, making that extraordinary statement, coming out at 2:30 during the markets. Quote, the fundamentals of the U.S. economy remain strong. However, the coronavirus poses evolving risks to economic activity. The Federal Reserve is closely monitoring developments and their implications for the economic outlook. And here's the operative phrase here. We'll use all our tools and act as appropriate to support the economy. So, Sarah, with the backstory here, I think, is the Fed was sitting there watching things develop, watching the market price these things in, and feeling that they had to come out with some statement that maybe said, hey, look, we are paying attention. We are ready to make a change. I do still think, Sarah, that the Fed wants to play a little bit for time here to know precisely what it's addressing. Are there quarantines? Are people stopping spending? How many cases are there in the states? I think it would love to have the 2 weeks or so till the meeting to make up its mind as to what to do. I don't know if it's going to get there.
Sarah, we were discussing how that statement came out, didn't really change the equity market mood. It has changed the dollar mood quite a lot. The dollar's weakened noticeably since that statement came out. And dollar yen, though, is now, dollar's down almost 2% against the yen just today, about half of that coming in the last hour or two. I mean, go ahead, Steve.
I just want to throw on the table something we've been discussing, which is, what if the level of the Fed funds rate is not what bothers the market? What if what the market wants to see is testing kits out there and some data about how many people in the United States are infected or could possibly be infected through the testing that hasn't happened? I would wonder if the market shrugs off this idea and the pricing of a 50 basis point cut by the Fed and doesn't react, you have to wonder if there are other places the market needs to turn for assurance.
Well, I think for sure, Steve, as we've said for a long time, this is not a financial factor that's hit the markets. It's a biological one and a confidence one. I do wonder, though, Steve, we had this debate a couple of days ago, you and I, particularly now we've had this statement. Does the Fed have any choice but to cut, perhaps now, as you said, by 50 basis points? Because they've teased the market just in the last few hours, and clearly over the last year and a half, they've delivered to the market just on fears, not just waiting for the data.
I think that's right. I think the data is in the market. I think the data is in the outlook. I think the idea, Wilf, is that it's hard to argue, given what's happened to stocks, given the concerns out there among corporations, that there is not some basis for a material reassessment of the outlook. I've been surprised that so many Fed officials, and guys in the back, if you have my wall on this, that Bullard today seemed to lean against the idea of a rate cut until there was, say, a global pandemic, that Charlie Evans, the Chicago Fed president, and there it is right there, well done in the back, guys. There's some of the comments that have been made, all of which have essentially leaned against the idea of a rate cut. Rate cuts are a possibility if there's a global pandemic. Evans says it's premature until we have more data, and Clarida says still too soon to even speculate. Well, you know, I think Powell may have changed that just a bit by saying that we're ready to use our tools here.
Steve Leisman. Steve, thank you.
Pleasure.
Let's turn now to the banks. Wilfred, you've been taking a closer look at their performance this week. Not pretty, like everything else.
Not pretty, and all this talk of rate cuts is hurting it further. And just want to reassess which of the banks have fallen the most over the course of this week and why. Banks, as we said, fallen sharply. The KBW Banks Index is now down 17% this week. It briefly touched bear market territory, down 20% from its January highs during the session. The two down the most of the big banks are Citi and Bank of America. They're both down about 19% now just this week. Now, why are they down the most? Well, the first is overseas exposure, particularly to Asia. Citi tops the list of the big banks. It's got about 22% revenue exposure to Asia itself. But by far the biggest factor is interest rates, which, as we all know, have collapsed this week, this year. And banks like higher rates. Why? Because it allows them to arbitrage better between the rate at which they charge borrowers and the rate which they give to savers. Here is the percentage of revenue for each of the banks that comes from interest-linked products, from net interest income, as we call it. Citi towards the top of that list again, and Bank of America also above 50%, seen as the most interest rate sensitive. The other factor I'd mentioned, guys, that's played into this was who had done the best last year was also suffering this year. And today, it's interesting, the two worst performers are Wells Fargo and JP Morgan, that hadn't sold off as much as Citi and Bank of America the week earlier. And JP Morgan, I just come to, down 7% now, over 7%. It's down $9 almost. I mean, that is extraordinary. I've never seen such a big move like that in JP Morgan. Still, Citi and Bank of America the worst this week, but JP Morgan playing catch up this session.
But sometimes it also is kind of a sell what you haven't sold yet type of an instinct. It's a slinky going down the stairs. You know, the two big bank stocks went down, the other one flops down. So it does show you that when you get into a sell-off multiple days, there are no kind of sacred core positions that you're not going to lighten up on.
Right. Financials now the worst performing sector. Lindsay, last chance trade.
In this type of market, you know, a lot of people, including ourselves, are saying you got to look for companies that are high quality with solid dividends, really, to get you through this period of uncertainty. Because even if we do see a bounce next week or near term, I think what we really need is confirmation that we're past the worst of this coronavirus situation, and we need to have clarity on the economic environment. So what I've been looking at really is J&J, it's down 13% since its February 5th high. If you missed the run up into the end of last year, it was up 20% from the end of October into that February 5th date. It has a 2.8% dividend yield, which is above its historical average. The valuation has come down. Cash flow, credit metrics look good in this name. Of course, they have the litigation out there with the opioid crisis and the talcum powder situation. But I think it's one that could be good to find some defensive exposure in this type of market.
All right, we've got 14 minutes left in the trading day. Dow is just down 1,000, now down 890. We are now in the closing bell market zone. Commercial-free coverage of all the action going into the close.
CNBC senior markets commentator Mike Santoli is here, and Lindsay Bell from Ally Invest, both still with us. Also joining us now, John Spallanzani from Miller Value Partners, which manages $3 billion in assets. Let's kick things off with a check on the broader market. Stocks continuing their sell-off this week, on pace for their worst weekly loss, since the 2008 financial crisis. We're down 3.2% on the Dow, close to 14% for the week. The volatility index above 48 at its highest level in the session. It's above 47 at the moment, highest level since August 2011 during the session. Mike, break it down for us in terms of what we're watching into the close. We're close-ish to the lows of the session, but we're just a couple of 100 points off them on the Dow.
We are. Fridays are the least common day that a sell-off bottoms. It's not that it never happens, because it actually has happened in significant moments, but it's the least likely. You don't typically want to see the market close at the lows on a Friday unless you're really looking for a final purge the next week. So those are tactics, right? That's the dynamic there. I think what we're really seeing, though, is this sort of liquidation type action through the year, through this week, has started with people feeling overexposed to stocks when the outlook changed suddenly, and has now spilled into selling because we were selling. And volatility being up means I play smaller and I take my bets off the table. That's what's happening right now. Arguably, we're in an overshoot phase. We came into today saying things look washed out, everything's very oversold. This is usually where at some point the market tries to bounce. However, those are the exact same conditions from which the market crashes. I mean, I'm not saying we're crashing, but the market doesn't crash from a really strong position. It does it when it's already so unsettled.
John, how are we setting up into next week?
Yeah, I think this weekend is going to be probably key to see if any other central banks join into what Powell said. So if we have a coordinated G7, G20 statement that says, hey, listen, we have dollar swap lines, we're going to provide tremendous amount of liquidity. We don't want to see corporate bond spreads blow out.
I mean, how much would that help in a public health crisis? Don't we want to see global coordinated intervention from health authorities?
Yeah, I think that we've kind of rolled over from a public health crisis, right? There's not a public health crisis in the United States. There's 300 million people. You know, less than 10,000 are being probably watched right now. But we're seeing credit spreads blow out. The VIX is at 50, and the market is telling us it has a fever, right? The market has a fever right now. So whether it takes a week, whether it takes 5 days, a month, we don't know how long it's going to take before everything shakes out. But we have seen credit spreads blow out. We have seen VIX blow up to 50. We have seen central bankers saying there's not a problem. And you know what? The market's saying there is a problem. So we need a coordinated message from somebody. We didn't get it from the CDC, really. We didn't get it from HHS. So we need really everybody on the same page globally that says we have this under control, and we know there's a problem. We're addressing the problem, and that's it.
Shares of American Airlines sinking to all-time lows. Phil LeBeau with more on how the sector is being impacted by coronavirus. Phil.
Sarah, well under $20 now for American Airlines. But look, it's the entire sector right now, down another 6 to 9%, depending on the stock today. You mentioned American. It's down more than 8% today. Meanwhile, Southwest, the least affected today of all of the major airlines here in the United States. For United Airlines, it is reducing its flights to Japan, Singapore, and Korea. Take a look at IAG, the parent of British Airways. Today, it said it cannot give guidance for 2020. Why? Because of the uncertainty that's created by the coronavirus, under major pressure today, almost 9% of a drop. And then you have Alaska Airlines. It is waiving change and cancellation fees through March 12th, joining JetBlue in waiving those fees for flights here in the United States. Remember, Alaska and JetBlue, you're primarily talking about people who are flying here in the United States, a few flights that might go down to the Caribbean, but otherwise, that's the United States, guys. So the pressure continues for the airlines.
Phil, why don't they get any reprieve from the fact that oil prices are down 26% year to date?
Because nobody has any confidence that they know how much traffic is going to drop off, especially transatlantic traffic. And remember, Wilf, that's the bread and butter, especially for Delta, American, and United. If you continue to see things like the Geneva Motor Show cancel, if you continue to see companies like Nestle saying no travel at all, what's going to happen with these transatlantic flights? We have yet to see them curtail that traffic. That's what everybody is focused on right now.
Also, the bread and butter for International Airlines Group, why they're down 24% for the week. Mike, these guys have suddenly become incredibly cheap. American, we say again, is 4.5 times PE.
They're certainly absolutely cheap if they're anywhere near going to earn what the current consensus is. And I think that's increasingly unlikely. The issue for investors is that the great operating leverage that they enjoy when planes are full and everyone's busy and businesses are spending, it just is running in reverse right now. So I think it's a difficult place to step in if you want to say, I want to bet on a comeback. How many big companies are already just starting to say we're curtailing business travel right now? And so that's going to be an overhang.
Yeah, we also don't know what it's going to look like in this country, and therefore we don't know what the decisions of consumers are going to be. Right now, domestic travel is fine. Right, Lindsay?
For now.
Can you buy this group?
I think it's a very difficult decision to make right now, especially because I know many corporations are really telling their employees that, ixnay on the international travel. Right now, domestic travel is okay, but it also becomes the fear of the consumer, too. Does a consumer get scared to get on an airplane? So
we've got 7.5 minutes left of the session. We've recovered a little bit. We're now down only 720 points on the Dow. Millennials are turning toward one group of stocks amid the sell-off, and Kate Rooney has the story for us. Hi, Kate.
Hey, Wilf, millennial traders on some platforms this week were picking stocks that benefit from coronavirus. Startup SoFi telling me traders are now buying, quote, plague stocks, or names that benefit from this outbreak. A lot of small cap biotech names on that list. Drug developer Moderna, for example, saw 100 times its normal buying activity. Spoke to some other retail platforms as well. Apple and Tesla were the top stocks bought by Fidelity customers Friday. E-Trade also saw a, quote, buy the dip mentality this week and a significant increase in volume. And Virgin Galactic and Apple are still the top names on Robinhood. Guys, back to you.
Okay, thank you. Let's check in on how consumer staples have traded this week. That sector getting hit hard, but it is actually the best performing sector of the week, down 12%. One ETF that tracks those stocks, XLP, that's down around 10% over the past 5 sessions. Some individual names that have multinational exposure, Procter & Gamble, Johnson & Johnson, Unilever. Unilever has more than 30% revenue exposure to China, for instance. Those stocks down sharply this week, Lindsay, which raises the question of where to hide in this market. You think consumer staples, they're defensive, they've held up, but, down 11, 12% is not exactly holding up.
Yeah, the problem with the consumer staples is their exposure internationally, but they do have the 3% dividend yield. I think if you can find some of the consumer staple names that are more domestically located, you can find some good opportunities in that group, though. And I do think that, when you look at these at big corrections or even bear markets, staples is one of the sectors that will do well.
Where are you guys?
Clorox is doing really well. We're definitely putting money to work. I won't say where, but Bill's a value investor. Our portfolio trades at 10 times before the market has a drawdown. So having a drawdown of 15% for guys like
in staples.
No, in stocks in general, not in staples. In some of the names that we own, I can't tell you what we're buying right now. But just to say that, as Buffett would say,
which sectors you're buying?
As Bill would say, we're buying some stay-at-home type stocks. We could say that. Having a 15% drawdown is a buying opportunity, right? If we go down to the 2018 Christmas Eve low, that would be 30%, but we'd still kind of be still above where this whole thing started. So when you get a chance like this, people dollar cost average, right, in 401ks. For the individual investor, I don't think it's 2008. It's no time to panic, right? You're dollar cost averaging, now you have a drawdown. If every time you have a 15 to 20% drawdown, you put in a little bit more than you normally put in, that is going to work over 20, 30 years. And we're value investors, so we're looking 3 to 5 years out. Every time the market goes down like this, we're looking for companies with good balance sheet, that have low multiples, that have good growth prospects, and we could actually put a position on.
How defensive, though, is your posture right now?
I would say we were more defensive prior to the drawdown. Remember, Tepper said with Jim Cramer at the Super Bowl, this is a game changer on February 2nd. The market didn't crack until the 19th when Bernie Sanders won 2 primaries. We had the G20 come out and said growth was going to slow, and we had a Monday gap lower. Once you have a gap lower, it's like a gap higher. Market gaps higher, and then it goes. You have a gap lower. We just cascaded down. There's no uptick rule, right? So all we're seeing is cascading lower. We're seeing guys raising cash who everybody kind of got trapped at the top, right? We were at 3,400. That Monday we gapped lower. There was a lot of selling from guys who did not get out at 3,400.
Just want to talk to what's on your screen in the moment. A little bit of a recovery in the last 15 minutes or so. We're now down only 566 points on the Dow, only 2.2%. The low of the session was down over 1,000, and we were down over 900 just moments ago. Mike, before we get to the internals, an encouraging little bounce into the close here.
It's certainly encouraging not to close right flat out at the lows, but I don't think you really, honestly, as much as it makes it's tempting to scrutinize every wiggle, the market is going to be so jumpy and animated at these times that I would say, yes, a net positive, most likely because people coming into the weekend, the Fed does 50 basis points Sunday or something like that, which if something is within the realm of upside surprise as well as downside shock. I just think it's a matter of trimming back some of the bets that are deeply in the money right now, which is anything bearish.
And then for the internals, what stood out for you today?
A little more two-way action, at least if you look at volumes, than there had been in the prior couple of days. Remember, we've had, I think, 390% down days. So, first of all, enormous volumes. That's one thing. You don't usually see 7 million shares on this, but, 5 out of every 7 stocks down is a lot better than 9 out of 10, at least on a net basis. Take a look, though, at new 52-week highs and lows. You would expect this to be massively lopsided, but that is a tremendous washout number. Almost so more than 900 stocks making new lows, only 18 with new highs. That is another deeply oversold measure right now. And then the VIX, people keep referring to it. It did get above, I guess, close to 48 or a little over 48 at the highs. It's still in fever mode. It's still not telling you that this wave has passed. However, if it does close like 3 points off the high, some people are going to say maybe that's a hint that we've crescendoed for now. So that's what I'm watching.
We've got just under 2 minutes left of the session. We are down 13% for the week as a whole on the Dow. Let's check in on bonds. Rick Santelli.
Wilf, even though we have really solid data all week, and today is solid Michigan, obviously it makes little difference at this point. Look at the intraday 10 as it sits, it's down 14 basis points on the week. Twos are down 19. Look at a 1 week of 10. Here as we hover right at 112, we're down 35 basis points. And if you look at what's going on in 2 years for the week, they're down 49 basis points. Finally, a month to date, because obviously we are wrapping up February. This is down 37 basis points. And do remember that the dollar index has given up a good chunk of gains as well. And Bertha, before the bounce, it looked like the lows closed since Halloween. Now it's early November. Doesn't make me feel much better.
I was just going to say that's really not a distinction without a difference. Microsoft bouncing here into the close along with Alphabet. But you take a look at these stocks this week, the biggest momentum movers that have brought us to new highs on the NASDAQ, they are selling down hard. Tesla, though, still up 60% for the year. Biotech is the relative outperformer. Not as bad with Regeneron, the only member of the NASDAQ 100 up for the week. Bob, over to you.
Hard to believe, but we have rallied almost 300 points in the last half hour. Point out a couple things moving. Exxon finally showing some signs of life after an absolutely brutal week. Some of the transports showing some signs of life, like Ryder, for example, also moving to the upside. There is the closing bell, capping an historic week, a 4,000-point move in the Dow Jones Industrial Average. Closing bell, Dow is going to close down about 13% for the week. The S&P 500 down about 12%.
That's a wrap on an ugly week. Welcome, everyone, to Closing Bell. I'm Sarah Eisen.
And I'm Wilfred Frost. Alongside us, Mike Santoli, CNBC Senior Markets Commentator.
On the plus side, if you're a bull, we did close well off session lows here for the Dow, down only 347. And I say only 347 because at one point today, we were down 1,085 points. But that does make it the 6th negative session in a row. And that does make it the worst week for stocks since the financial crisis. For the week, the Dow's down about 12.3%. S&P 500 is down about 11.4%. It closed the day off 24.5 points, down 0.8%. The NASDAQ composite, which had been doing better all year, but also gave up its gains for the year. It's down 4.5% for the year. Closed actually positive. Wow. That
got three sectors.
Once before in the day, as you can see, came right back lower and then closed positive again. Let's just check out the Russell 2000 index of small caps, which also had a very tough week along with the rest of the market. Today closing down 1.4%.
Three sectors on the S&P got into positive territory by the close. Energy up over 1%, technology and communication services, all part of that big rally that Bob Pisani pointed to in the last 20 minutes or so of the session. Coming up, Mike Novogratz is here to weigh in on this week's sell-off and where he sees opportunities in the market. We'll also hear from Eurasia Group's Ian Bremer, his thoughts on the coronavirus and how much of a hit the global economy could take as a result.
It has been a brutal week for the market. Take a look at the Dow's daily point drops this week. The worst week since the financial crisis. They were big and they were severe. We had more than 1,000 point closes lower for the Dow. Tuesday was down 879 points. Every day was lower. Joining us to discuss is Gabriela Santos, global market strategist at JP Morgan Asset Management, which manages $2 trillion worth of assets. Still with us is John Spallanzani from Miller Value Partners and Lindsay Bell, Chief Investment Strategist from Ally Invest. So first to you, Mike. After a rough week.
Yes.
We did close off the lows and got into positive territory for the NASDAQ. What does that mean?
It means the rubber band was stretched very, very tight. Coming into today, you had a deeply, deeply washed out market. It also is the last day of the month. So I do think if you were correct in leaning negative all week, you want to just knit that up and take your profits going into the weekend, as we're talking about potentially Fed officials, central banks trying to interrupt this vicious cycle of selling begetting selling. So I think all that stuff together, end of the month, if you were going to rebalance, you did it on the close because you had a great opportunity to how well bonds have done relative to stocks. That's all I would say, and it's good to finish off the lows on a Friday, but essentially every rally is sort of suspect here, and it could be ripping ones, and you still have a high burden of proof that this little phase is working its way through.
Lindsay, what's your message to all the retail investors that have been phoning in all week? Clearly, they've been fearful. Is this a sign, the way we kind of rallied into the close, that, again, things go both ways when we're seeing this level of volatility?
Right. Yeah, exactly. But, also don't get back to being complacent either, because even though we had a nice move off of today's lows and maybe next week we get a bounce if the Fed or central banks around the globe make that coordinated movement, there's still plenty of things we need to watch out for. And that's, first and foremost, the spread of coronavirus, especially here in the U.S. That's going to unnerve investors. Watch the levels of the VIX, see where we go from there on that. The 10-year, obviously, that's a huge data point that we need to keep our eye on. We want to see some stabilization there, because I don't think you can really get stabilization in this market until you have stabilization in the bond market.
So we're now about 13% off the record highs. Gabriela, the magnitude of the declines, how does it stack up for you, given some of the uncertainty and the risks and the potential economic pain that we're facing as a result of this coronavirus?
Yeah, so it's been absolutely a U.S.-led sell-off this week. And to me, that says more about how stretched U.S. valuations were relative to the rest of the world. U.S. markets hadn't really corrected despite the emergence of the COVID-19 virus. And we had already stretched valuations coming into this year. So to me, it says much more about the need for multiples to come down to reflect a greater uncertainty around the impact of COVID-19 on earnings, as well as the economy, of course. But it says more about just how stretched valuations were, really.
John, what are you looking out for over the weekend, whether it's data or announcements that could give you confidence to go back in a meaningful way into equity markets?
I think we saw a good sign, like Mike said, on the close, right? The VIX came down. We saw money move into Carnival Cruises, which was a stock that was, the market was down 15%. Some airlines and cruise lines were down over 50% because of this virus. So the market's a discounting mechanism. It really discounted a lot of bad news. We have China PMI this weekend. Hopefully Lagarde, right? I know she's a friend of yours.
ECB, I don't know.
I hope
you're waiting for her to do something.
No, not
the
that
Financial Times yesterday.
Yeah, I know. I saw that.
It's
but
not a shock, and she didn't seem willing to do something.
Yeah, not that they have to do something, but the market, words matter, right? Even for central banks. And I think Powell coming out today and saying what he said was important, especially when all the other Fed speakers today were not saying that.
I think it's important that the Fed and other central banks don't make it worse, that they look like they're on top of it. But when it comes to actual comfort from the problem that's ailing, I mean, don't you need to hear from public health officials? Don't we need to see what's happening in places like Korea or Italy, where we can tell what's happening with the spread, what the mortality rate is, how much consumer behavior has changed, that sort of thing?
Yeah, China, things leveled off. Singapore, I think things have really...
It's hard to get a clear picture.
It's hard to get exactly. But Singapore, things have gotten better. Europe, the cases are still lower. I mean, the market's telling you that it already discounted things getting worse. Now, like you said, if there's an antidote, something coming out of an Israeli drug company, something that they're fast-tracking everything at the FDA to have whether it's a vaccine or an antidote, those things are positives, and it's going to happen sooner rather than later, I think.
Now, it's been a crazy week, of course, on Wall Street. Let's check in with Bob Pisani on some of the standout movers for the week.
And, Wilf, I just want to highlight the remarkable 400-point move in the Dow in the last 20 or 30 minutes. We saw Exxon was positive, but we saw Microsoft, Nike, Visa, Caterpillar, United Health, all turning positive as we went into the close. Remarkable move, but it didn't hide the fact that it was just a terrible week. And what was remarkable is right across the board, didn't matter what sector you were really in, there was an overall takedown of the entire U.S. and indeed the global markets. Take a look at some of the big movers for the week. American Express down almost 19%. Again, rallying a little bit into the close, but Boeing 17%, United Health 17%, J.P. Morgan 16%. I would note the banks were especially poor performers overall. We did have new lows today in a number of the big names, Comerica, U.S. Bank Corp, Wells Fargo, and Zions among them. U.S. market capitalization took a big haircut, a lot of trillions being flown around. I like to use from the February 19th high, the U.S. stock market capitalization was $33 trillion, ended today about $29 trillion. That's a decline of about $4 trillion, 13% decline in overall numbers. There you see 13% down in market capitalization. That's an awful lot of money there, folks. $4 trillion in about 2 weeks. Guys, back to you.
Yeah, wipeout. NASDAQ down 10% for the week, but quite a comeback into the close. Bertha Coombs has more. Bertha.
Yeah, NASDAQ basically up 2 of the last 5 days, but that didn't help for a gain. And some of the most bruising losses coming with the airlines. American Airlines hitting a new low today. Tesla, one of the biggest losers as well. But Tesla's move has been so big this year, even with this huge pullback this week. Take a look at the year-to-date compared to some of the others. Apple right now is the biggest drag on the NASDAQ 100. Netflix has really outperformed this week as people look at those stay-at-home stocks. And as you look at the year-to-date movement, we've seen higher highs, lower lows this month, really exacerbating the movement that we saw in January, particularly when it comes to the chips. The outperformers have been relatively the software stocks. Zoom, the best performance there. That's the video conferencing firm, up 50% year to date. Over to you guys.
Gabriella, just wanted to come back to what you guys have been telling clients during what has been, of course, a torrid week. What's the main piece of advice? And over the weekend, how should they be thinking about their portfolios?
So we've been speaking, and we speak to a variety of clients, and we've been telling them what an important gut check this week has been. So we have some clients whose first instinct it is to ask, should I be selling right now? And the important thing to check is, do you have enough exposure to insurance? Do you have enough exposure to core bonds? We've seen yields fall dramatically. Treasuries do still do the trick when it comes to mitigating the downside. We have other clients whose first instinct is to ask, should I be buying right now? And then we'd be taking a look at parts of the portfolio that might be underweight, things we actually like emerging markets, like value stocks, and then we would be adding over the next few weeks. But it absolutely depends on risk appetite and time horizon.
Well, what's your ratio to people asking if they should buy versus people asking if they should sell?
We've been hearing both, Sarah, honestly, and that's why it's actually a very personal decision and not a blanket recommendation that we can make.
John?
I have a funny story. So basically the way it goes is that I have friends call me and say, what's going on with the market? Then I have relatives call me and say, what's happening with the market? And then when my mother calls, that's the bottom. So
she called you?
So when did she call?
She called me last night.
3:45?
No, last night.
What we usually say is when we get a lot of company from our colleagues and friends and other news networks, which they have crowded into the New York Stock Exchange today, that means public awareness is pretty high.
It's always a good sign. By the way, that's the same reason that a Fed chairman putting out a public statement or a Treasury secretary calling the banks and saying so. That's just another sign of the extremes we've gotten to and a kind of psychological capitulation. I'm not saying it's in right now, but that's kind of what we're signaling. And with the Fed's move, I agree. It's not going to direct itself at the core issues, but it's a matter of offsets, and it's making sure that it buffers the financial implications of a kind of runaway panic type move.
Now, the energy sector crushed this week. Let's get to Brian Sullivan, who has more. Brian, a little bit of a reprieve at the end of a terrible week.
Maybe John's mother called the oil market as well. You know, she should call Exxon and Chevron and everybody, John. You know what I mean? All right, so let's talk about the week that was. I had to take off my tie because it's that kind of a day. Here's the thing. Oil had its worst week since 2008. We're at $45 a barrel, losing more than 15%. The oil stocks, they got whacked as well. You look at the declines in ExxonMobil, Chevron, Oxy, Occidental down 24%. There's 2 points, guys, I want to make, and you can follow up or not. Here's the thing. Number one, if you look at the XOP ETF against the price of oil, here's what's fascinating. And in no way am I defending oil stocks or saying anybody should buy them. It's not what I do. But oil stocks as a group are trading at a cheaper price now than they were when oil was at $26. And that's probably because of the heavy debt loads. But the reality is oil is not at 26. It's at 45. But oil stocks are trading less. Here's the other random but interesting stat for you guys. Occidental Petroleum, OXY, it bought Anadarko for $57 billion last May, including debt. Occidental's market cap now is $28 billion. So they paid $57 billion for Anadarko, and their current market cap with Anadarko is $28 billion. We did get a little pop on some of these names toward the end, but I thought those are some stats that you can wow and amaze your friends with at John's cocktail party tonight.
Yeah.
Brian, thank you. I mean, it speaks to the carnage in energy, Mike, but one of the important points here is that energy was getting beat up even when the stock market was hitting record highs into this big sell-off.
That is true, right. So it really is much more of I think, a longer-term kind of surrender trade that's happened here. Again, it's hard to call bottoms based on, 1 or 2 days action, but it does seem as if there are many sold-out parts of the market where essentially people feel like they can't even touch them or consider them, and energy is absolutely one of them. I do think that you'd want to see the rest of the non-equity markets start to kind of come into line. You want to see yields up. You would like to see a floor in crude and all these other things that have been related to what's been going on.
John, energy stocks cheap enough?
Yeah, I think that one point that I think some people neglect is that energy, there was obviously oil prices are down, high debt load, but the whole pivot to ESG stocks, right, kind of put a damper on energy stocks, right, with people saying they're not going to lend to them, they're not going to have them in their portfolios.
You guys are value investors, though.
Yeah.
Would you go there?
We're looking at some energy stocks, I will say that. I think that there's certain, again, the biggest thing with any of these stocks that we're looking at is the debt load, right? The debt to market cap is really important, especially when you see credit spreads blow up. That's what happened in 2008. You know, when the tide goes out, you see who's exposed. So if you're running a corporation, and just like a hedge fund, if you have 10 times leverage, which means if you have a lot of debt on your balance sheet compared to your earnings, that's a problem when the tide goes out.
Well, and for energy companies too, it is really about the price of oil at $45 a barrel. That's pretty low. As Brian, sorry, Brian, as he said, I mean, oil prices are down so significantly this year. Earnings for these guys are so highly correlated to the price of oil, and the energy sector in general, it's 3.5% of the S&P 500 now. So a lot of funds
the worst
don't have
performing
to have
sector this year
to it. Either.
No, oil's down 26% for the year. Yeah. Thank you all, Gabriela Santos, John Spallanzani, and Lindsay Bell. Good to have you on a day like today. The Dow closing lower by 357 points today, down more than 12% for the week. Joining us now by phone is Mike Novogratz, the founder and CEO of Galaxy Digital. Previously, Novogratz was with Fortress Investment Group. He ran its macro fund. Thanks for calling in, Mike. You know, you were sitting here, I don't know, when was that? A few weeks ago, and saying you were super bullish because you were expecting big bazookas. Are you still feeling that way?
Well, I tell you what, Sunday night, I was out skiing in Jackson Hole, and I got a call from my guy, and he said, listen, Bernie's surging, and Corona is getting much worse than we thought. And I think, pre-Sunday, everyone was looking at Corona as a China issue, and the China stats are slowly getting better. It looks like it's peaked there. Who knows if you can trust the data, but that's kind of the consensus. And I think on Sunday, the world changed. And we're saying, wait, if this thing goes viral all over the world, that's going to scare the heck out of people. And conferences started being, canceled. I don't know a person in New York City that hasn't canceled a trip somewhere. And so that fear took over. And the Bernie surge, you can't discount, the Bernie surge. It felt on Sunday. Now, who knows after Super Tuesday how we feel. But all of a sudden, he becomes the predominant candidate. So you've got two big negatives. And it just started a fear cycle. And I think, it feels like that potentially bottomed today with S&Ps down at 50 below, at 2850. But we'll see.
Mike, if you do expect the bazookas to come, whether it's from the Chinese central bank or now from the Fed, how fearful are you that that's already priced in? Where you look where bond yields are, or you look at the fact that the Shenzhen index is actually up this month and up this year already. It's as if the market is already priced in.
China's a special place in that it's illegal to short. The government can buy. They're jamming in lots of liquidity, and they're doing a lot of things to promote the equity market. And so I don't think it's a fair assessment. Listen, I had thought gold and Bitcoin, would do well, and they did do well until people just got scared out of their wits, and then it became just get me to cash. And so, gold selling up $100 when indeed we're going to have more liquidity from central banks and worse fiscal policy. It's a great indication of this was just a panic risk-off. And so I do think gold ends up bottoming somewhere and heads back up and, ends the year much higher. And I think the same thing with Bitcoin. But, we went from manageable markets to, end of the world type fear. I've had friends talking about depression, global depression. And, when that fear gets into the market, people thought today could crash. And I think, listen, the Fed came out, I think, pretty proactively and said, we're watching and we'll cut rates. I broadly think they've just given us at least one cut in March and maybe 50. The market's kind of pricing halfway in. Trump's guys came out and said we're going to do a tax cut.
Well, they didn't say that. There's a report that they're looking at it.
Right. Okay. So that kind of sentiment, I think, in the long run means you're going to see much steeper yield curves in time. And you're going to see assets like gold. And quite frankly, stocks will re-rally once they finish selling off. The one thing that scares me a little bit is if you look at growth versus value, which was completely correlated with the S&P and the NASDAQ, it hasn't really rolled over at all. Everything kind of sold off together. And so the big quant funds haven't had terrible weeks. Usually on these kind of sell-offs, the big multi-strat quant funds get destroyed. And I've been talking to a couple of them, down 60 basis points, down 70 basis points, nothing like you've seen in other past sell-offs. And so we haven't had as much damage in the internal of the market that you could have.
Mike, to your point that you said you actually think gold and Bitcoin will rally again and end the year higher, that's not particularly bullish for equities, is it?
Listen, when you again, as the markets are discounting, and so when you kind of wash out the excess of longs and you start we're going to stimulate the heck out of the economy again, markets look forward. And so I don't think we've seen the high of the year in equities. Unless Corona really puts us into a depression, unless everyone stops traveling and this thing really accelerates all over the world. But if what happens in China happens in all the other countries, and it kind of hits a peak and starts getting a little bit better, I think, this or maybe a little lower will prove to be a great buying opportunity.
I just wonder how you can say that. It feels like the market is waiting for some more concrete news on how this is developing either outside of China, what the mortality rate is going to look like, how many people get infected in this country, what consumer behavior is going to be. These are all such unknowns.
So, when it originally came out, I think Paul Jones was on either your show or someone, Paul Jones, and he said no one should have risk on for 3 weeks. And where he was wrong is no one should have had a risk on for 6 weeks, because we all got kind of lulled to sleep that it wasn't so bad. And it's now been, 6 or 7 weeks, and it's now looking bad. I think we're not going to know for a while how the U.S. plays out, how Europe plays out. Do they cancel X conference? People are talking about the Olympics, and so if it gets worse, listen, the markets will get worse. I'm not Pollyannish, but I do know central banks and ministries of finance are going to hit the market with a lot, and so that usually at one point provides a floor. It also should mean the back end of yield curves. I mean, you can now borrow, in Austria, 100-year debt at 60 basis points. That seems ludicrous when you've got Germany who's finally saying, "Hey, we're gonna be looser on the fiscal." And so, I do think the big trade opportunity of the year later on is going to be short fixed income.
Mike, thank you so much for joining us.
That could be. Yeah. Mike, thank you.
All right,
be well, guys. People listen to you.
Mike Santoli, just wanted to follow up on that. The point of a big bazooka of central bank action to come. I mean, going back to what Steve showed us earlier. The market's already expecting not just a 25 basis point cut, but almost a 50 basis point cut as certainty. So to what extent will that not, in fact, deliver a big jump in equity markets?
I think it certainly creates support. You don't know if it necessarily... First of all, it's priced into the bond market. We don't know if it's priced into the stock market. And I do think when you get confirmation, if you look back to last year, the market ran ahead of the Fed the entire year. The market was pricing the Fed, essentially forcing its hand. And before you got those cuts, the fixed income market was already there. And then the stock market still managed to get some benefit, at least seemingly, from the actual 3 cuts, and then we're done and we're going to be on hold for a while. For a while was actually the bull case, was that the Fed was on hold.
How about that little gem that he just left us with, that the opportunity of the year is going to be short fixed income? That's a tough call to make. There's such a wave
the
of
Widowmaker, yeah, exactly, trying for it again. I do think that there's a case to be made. First of all, everything you would look at in terms of the way that fixed income is positioned, the speed and angle of the rally in bonds, just exactly how people love them right now, and the whole world's been forcing their way in. Sure, I do think there's a setup to take the other side of that. It's been very, very, very tough to make that work because it's just such an undertow toward low yields around the world.
I remember when the 10-year was an entire percentage point higher, and the likes of Jamie Dimon said, "Oh, we may not, yields have bottomed."
How many times?
18 months ago.
Warren Buffett's been telling you to think that bond yields are too low for years, and a lot of smart people have, and it just simply has not played. However, you have had massive sell-offs in the bond market on an interim basis, all the way down in yield.
But here we are again, 118, unbelievable. Don't miss the CNBC special report, Markets in Turmoil, tonight at 7 p.m. Eastern. They'll discuss all of this and what to do with your money next.
Now, another major sell-off on Wall Street, of course, as coronavirus outbreak fears spread. Let's get the latest on the virus. Meg Terrell has that for us. Hey, Meg.
Hey, Wilf. Well, this was the week we saw the virus really go global. New cases in South Korea alone at more than 500 today, surpassing those in China. More than 50 countries now reporting cases. Nigeria, the first in sub-Saharan Africa, and Mexico, the second country in Latin America. Both countries' cases in travelers from Italy. In the U.S., expanded testing guidelines and capacity from the CDC, which says it's sending improved kits to state and local public health labs. This as health officials investigate the country's first potential case of community transmission in California, tracing the person's contacts and investigating how she may have been exposed. And finally, a warning this afternoon from Bill Gates. In the New England Journal of Medicine, he writes, quote, "In the past week, COVID-19 has started behaving a lot like the once-in-a-century pathogen we've been worried about," saying in addition to addressing this immediate crisis, billions of dollars must be invested in preventing future pandemics. Guys?
Meg Terrell. Meg, thank you. Let's take a look at how we finished up on Wall Street today. That was a pretty big rally or comeback into the close from the lows of the session. The Dow actually ended lower by 357 points. At one point, it was down 1,085 points, and really wasn't until the final few moments of trade that it just climbed right back up there. The NASDAQ finishing in positive territory, just barely. The S&P 500 down 0.8% on the day. The Russell down 1.4. Still, though, a brutal week of selling, relentless selling, down 7 days in a row. Worst week since the financial crisis for stocks. 10% declines across the board. Back to Mike Santoli for a look at some of the damage and what it's done to valuations.
Yeah, exactly. So it has certainly adjusted equity valuations lower, especially relative to bond yields. Now, we've been looking at bond yields and their decline as a negative signal, obviously, for what it means for risk appetites and the inflation and growth outlook. However, it does, if earnings can hold up by any stretch, make stocks look on a relative basis attractive, even though they're not absolutely cheap. So this is a measure of the equity risk premium. So it's the earnings yield for the S&P 500. That's the upside down version of the price earnings multiple against the 10-year Treasury. And it's gotten up into this zone where we've seen support for stocks develop. So this would have been obviously late 2018. We were a little bit better there in terms of equity valuations. And then a couple of times at the bottoms of the sell-off last summer, also there. Now, we were cheaper in early 2016 when we had that sort of Jamie Dimon bottom and the whole thing. And we did have the absolute valuations on stocks lower. So what you could basically say is earnings might not hold up. And therefore, the earnings yield on stocks might, in fact, be lower than this. But at least you're starting to rebuild a relative valuation cushion. And then if you want to look at dividends, it's a kind of a similar story. The dividend yield on the S&P 500 compared to corporate bond yield. This isn't just treasuries, but this is kind of investment-grade corporate yields. This is from FundStrat. And what you see is basically dividend yields give you a higher percentage of the yield of high-grade bonds than they have in 25 years. So if you think that that's a relevant statistic or a little bit of comfort in terms of deciding to have some equity exposure, that's where we are right now.
All right, Mike, thank you. Just want to point out some news that we are getting and we are learning here at CNBC, and that is that Harley-Davidson is going to have a leadership change. President and CEO Matt Levatich is going to be stepping down as president, CEO, and board member of the company. The current board member, Jochen Zietz, is going to be appointed acting president and CEO, will become chairman of the board. Levatich will help assist the transition through the end of March. Just wanted to share that as soon as we got that for a stock, Mike, that has been hit really hard. Not sure the why here. I'm just getting the announcement of the changes, but clearly this has been a pressured one. It's been a target of President Trump.
Right.
And it's suffered from some secular changes like young people.
Exactly. It's certainly a strategic and brand issue that's been in the background even before you had the trade-related and some cyclical concerns there.
All right, it has been a wild week on Wall Street. Dow dropping 357 points in today's session. Here's a look back at how we got here. Dow closing lower.
I think we're at a point where it's too early to either say this is very concerning or it's not concerning.
I don't think this is a time, in general, based on fundamentals, that one should have more risk than usual.
It is the fourth day of declines in a row.
We should try and resist our inclination to buy the dip.
Uncertainty is the way the market should function, and that's what will create the opportunities. And I'm just saying, be patient.
The Dow was attempting to close higher, but we did not get there.
This will take 8 to 9 months, I think, to roll its way through the markets and for the markets to re-rate.
We've taken some air out of the bubble, and that's constructive.
Worst points decline for the Dow ever.
This is a pretty good time to be an investor, to think about where can you find opportunity.
Reminding investors that panic is not an investing strategy.
Well, that's a wrap on an ugly week, and that does make it the worst week for stocks since the financial crisis.
At the very least, on Sunday night, before markets open, have a unified statement from the big central bankers in the world that they are all over this.
I urge everybody, be calm, be cool, and be collected. But my God, don't give up on America and don't give up on the world.
Oh, that was emotional.
Yeah, it was indeed. I mean, it was a crazy week, an emotional week. The Dow lost 12.4% for the week as a whole. S&P, Russell, NASDAQ, all down more than 10% for the week. Extraordinary roller coaster ride it was, summed up just there. Let's bring in Jason Katz, Managing Director and Senior Portfolio Manager at UBS and Forbes #1 high net worth advisor in New York. Jason, good to see you. Sum up for us, now that the week's closed, what you'll be advising clients to do over the weekend. We've got a bit of time to pause and think, should they be putting a bit of money to work in equity markets?
It's interesting listening to your recap of the week. That seemed like a year ago on Monday. We're counseling clients to take a deep breath and use this weekend to reflect on the fact that the markets had made a meaningful move up last year and up until recently, and that corrections are par for the course. Obviously, this week didn't feel normal by any means, but on balance, markets correct 10% a year since the early 1900s. So we don't need a rate cut, we need a vaccine, and the only cure we need is time, because we need 14, 20 some odd days to see how, in fact, this plays out. So I think the best trade at a minimum is no trade. And if you're fortunate to be liquid or underweight equities, I think you need to consider legging, which we did today.
What would you tell people about switching portfolio moves into more defensive sectors, for instance, versus cyclical sectors? Is it a time to do that? Is that something you're advising?
Oh, that's the antithesis of what we're telling people to do. The defensive trades have gotten incredibly crowded. Up until recently, obviously, gold had a tremendous run. The 10-year below 1.2%, utilities making highs. I mean, over a longer period of time, these are assets that are not going to beat inflation and help an individual reach their goals.
Jason, in terms of bond markets, clearly they've been a great hedge, and clearly yields have continued to compress much more so than many people have thought. Do you start to get to a point where that no longer looks attractive, even if it's worked as a hedge in the past?
We're at that point. I think it was Leon Cooperman on your show that said buying fixed income is stepping in front of a steamroller to pick up a dime. Now, he said that months ago, and the appreciation of those bonds have been arguably better than the stock market. That being said, for new fixed income, you need to keep your duration super short here.
What about gold at the moment? Clearly worked as a hedge brilliantly for the early part of the year, but has slipped quite significantly in the last couple of sessions.
I think gold is an important component of a portfolio here. It serves as a hedge in times of adversity. I do think that with the dollar's weakness of late and rates remaining as low as they are, the cost of carrying gold is a good insurance policy. I wouldn't go more than 5% in a diversified portfolio, but gold and other hedges like Treasury inflation protection securities are what we're counseling clients to do on the defensive side.
Jason, would you make your message different based on the age of your clients? For instance, is there different tactics to do right now if your client is young and has a much longer time horizon versus someone who's on the edge of retiring?
It's a great question. I've had no shortage of calls today. And interestingly, up until today, there hasn't been an avalanche of emails or calls. But today I spoke to people of a variety of different generations. For the younger investors, I'm telling them if you have a market cycle at a minimum as a horizon, you need to remain long equities and think about being modestly overweight equities. Certainly not doing it by diving in headfirst into the shallow end because we don't know the depth of the water at this point, but tippy-toeing in right now as a younger investor, for sure. Obviously, if you're a little bit older and you don't have that runway, if you haven't de-risked and you're not thoughtfully diversified, you need to raise a little cash.
Jason Katz, thanks for joining us.
My pleasure.
And don't miss tonight a CNBC special report, Markets in Turmoil, 7 p.m. Eastern Time.
Still ahead, find out whether Eurasia Group President Ian Bremmer thinks weakened global alliances could hurt the effort to fight coronavirus. Plus, an expert in infection prevention and control tells us how well masks, hand washing, and cleaning products fight the spread of coronavirus.
But first, Seema Modi looks at how 3M is ramping up production of face masks.
This N95 respirator has quickly become the symbol of the fight against the coronavirus outbreak. Coming up, an exclusive behind-the-scenes look inside 3M's manufacturing facility, where they're really working around the clock to meet the surge in demand for these face masks when Closing Bell returns.
CNBC News Update is sponsored by Comcast Business. Take your business beyond at ComcastBusiness.com.
Markets. The business of trading goods and services. NASDAQ operates among the largest markets in the world, and our technology powers markets from Indonesia to Chile. Great markets are built on a foundation of trust and integrity, forged through leading-edge technology and a smart regulatory framework. As technology advances, regulation must keep pace to allow the markets to evolve. Today, we see an opportunity to modernize regulation, to make markets more accessible to investors and entrepreneurs of all sizes. From the graduate buying her first stock to an institution investing in thousands, the markets belong to everyone and stand as a symbol of economic advancement, social progress, and limitless opportunity. That's the tomorrow that we envision.
And to get there, we'll have to rewrite it today.
Don't just plan to retire, plan to live. An annuity helps cover your essential monthly expenses, so you're free to live the life you want. Find out how an annuity can give you lifetime income at protectedincome.org.
The worst week since the financial crisis, as the coronavirus continues to spread. Where can investors turn for safety? Be prepared for the week ahead. Markets in turmoil. Sunday, 7 p.m. Eastern on CNBC. Watch or listen live on the CNBC app.
I got things I want to do, but student loans were holding me back. Credible.com helped me save $600 a month with a great rate. Now I can go do what I want to do.
Visit Credible.com to see how much you could save on your student loans.
Hey, guy, ED issues? We got this. Today's your day. Go to forhims.com/ED.
All of my patients should have a Dexcom because it's just more information. Why wouldn't you want that?
Being able to see your numbers in real time gives you the knowledge to see the future. It's awesome.
Dexcom showed me that I was doing a dip and then a spike in the middle of the night, which allowed me to adjust my basal rates. I'm not waking up in the middle of the night and my numbers aren't going crazy.
Now you are in control, and that is so powerful.
Welcome back. Quick check on how we finished up the day on Wall Street. Not as bad as it has looked the previous days this week. Still lower for the Dow, down 357, which was actually a big comeback from the lows of the session, which was down more than 1,000 points, which would have made it the third day down 1,000 points. Still, we looked at our worst week since the financial crisis for stocks. S&P 500 lost about 0.8% today. The NASDAQ actually finished positive, just barely, and the Russell 2000 down 1.4%. It all adds up to losses of 10 to 12% for all the major averages just this week. The spread of the coronavirus sparking a global race to fulfill orders for face masks. Seema Modi joins us with an exclusive look inside 3M's manufacturing plant, where they're adding new assembly lines to increase their output. Can they get it done fast enough, Seema?
That's a big question, Sarah. 3M is increasing capacity to meet the acute shortage of these respirators. Behind me is an active assembly line of the N95 respirator. That is the most popular face mask on the market. The combined face shell is met with protective layers and filter media. And right here in my hands is the
is the final product, the N95. Now, with no vaccine on the market, medical professionals are increasingly relying on this protective gear to stay safe and also to reduce the risk of getting infected by the coronavirus. But there is a shortage in the market. The HHS says there's already about 60% of large-scale pharmacies that have run out of the face mask, and that's why their pressure is really on not just 3M, but Kimberly-Clark and Honeywell to increase production. Here in Aberdeen, nearly 650 employees are working around the clock. Yesterday, the company held a jobs fair, and in many cases, they made offers to a number of individuals so they can increase the headcount and also help more people work here as they try to increase production, guys. Seema Modi. Seema, thank you. Clorox stock hit an all-time high earlier today, although shares did end the day lower. There is currently no vaccine to prevent this coronavirus outbreak. But how effective are preventative measures like wearing face masks and using hand sanitizers and wipes? Joining us now is Dr. Emily Landon. She's the medical director for infection control at the University of Chicago Medical Center. Dr. Landon, how do you answer that question?
Well, there are a lot of things that we can do to prevent spread of viruses. We use them all the time to keep us from getting regular colds, and they may not seem very high tech, but they can do a lot. They can go a long way toward helping slow the spread of things like this nasty coronavirus.
Face masks specifically, I've seen mixed reports that they work initially, but as soon as they get any level of moisture from your breath or anything like that, that they cease to work. What's the advice?
Well, first of all, there's multiple different kinds of face masks. There's the surgical mask that people wear that doesn't really seal up very well. That's super good if you put it on the patient who's sick, because that will contain their secretions and protect everyone around them. However, if you're the one who wants to protect yourself, those N95 masks you were just showing are much better. They have a tight seal around the face, but you need to be fit tested in order to know exactly which size you should be wearing, and you have to be trained on how to wear it properly, and they can get pretty uncomfortable, so they're not a great choice for just sort of going out in the public.
Yeah, you also have to shave your beard if you want them to fit well, according to the CDC, which has a whole picture on how to do it. What about hand washing versus sanitizer? Which one's more effective, and do either of them really prevent this?
Yeah, keeping your hands clean so that you don't touch your face, no matter what things you're touching with your hands, is a really important piece of preventing infection in hospitals, in schools, and everywhere you go. Soap and water works really well. It can dry out your hands a little bit more, but when you do it, you want to do it right. That means getting your hands wet with warm water, cleaning them, getting all of the surfaces with soap for 20 seconds. That's a full time through happy birthday. And then also rinsing them off afterwards. So soap and water is your best choice when you have visibly soiled hands or when you haven't washed your hands in a long time. In between then, I recommend hand sanitizer, alcohol-based hand sanitizer. That's what we use in the hospital. That's what protects our healthcare providers from patient illnesses and protects each patient from catching what's in the next patient's room. So those are available to you, and you can keep them with you in these fancy little packets. I carry them with me. That's what I use.
And Dr. Landon, what about the other things that we would typically do in and around flu season to try and stay healthy, like take vitamin C, take other supplements like echinacea, and try and make sure we get plenty of sleep? Do those apply, or because it's a kind of unique viral infection, is that not really applicable?
It's not clear whether or not echinacea and vitamin C are going to be super beneficial, but if you feel confident and you've tolerated them in the past, there's no reason not to try them. Sleep, though, has been shown. A good night's sleep has been proven to help reduce your risk of getting the common cold, and so I think it's probably a good idea. Although we don't have clear evidence for this coronavirus, it's not going to hurt.
And just quickly, one more, sorry, Dr. Landon, in terms of the debate around when we get to spring and summer and the weather improving, is that relevant at all or not?
I really, really hope that works out, but I don't know if it's going to. I'll remind everyone that 2009 H1N1 came along in April in Mexico and then spread through the United States all through the summer, and that was an influenza, which should be long gone by July. So I don't know that we can expect, with a completely susceptible population, it doesn't really make sense to expect that this is just going to fizzle out as soon as we get a little bit more sunshine.
Dr. Landon, thanks so much for joining us. Much appreciated. Let's get over to Mike for another look at the dashboard and the latest charts.
Yeah, well, in this case, surveying some of the damage in some of the stocks that really would have led us into this pretty profound correction that we've had. Now, these were stocks that were extremely weak even going into this week when the broad market sold off. And what I think is relevant, we can't, extrapolate this as a firm trend, but every one of them has finished off the Thursday lows. They made a pretty significant low early Thursday. Now, keep in mind, this is Royal Caribbean, Booking Holdings, Noble Energy, it's a driller, Marriott, and Qualcomm. So this is either travel-related, energy-related, or semiconductor China-related. So often what you want to do is see the stocks that basically spilled lower before the rest of the indexes did, and to get some sign as to whether it's seeing some selling exhaustion. I think you could tentatively say by the end of the week, perhaps we did. It could just be a pause, but it is one of those things to throw onto the pile of indicators that shows that perhaps this wave of selling might have worked its way through for now.
We are just getting word that we'll hear from the president momentarily. We'll take you to it as soon as we get that. As far as leadership from the White House on this sell-off, on this coronavirus outbreak, what do you think investors want to hear?
It's been difficult to kind of feel as if there's been much tangible there. Obviously, Larry Kudlow speaking this morning didn't really have too much of an obvious response there. But no, I think the idea is, when are we going to get relevant real-time information about how many cases, what are the testing, are we on top of the issue?
As we await comments from the president, a reminder, we closed the week down 12.3% on the Dow. Let's listen to the president.
Thousands of people outside, and it's going to be very exciting. We have a big day tomorrow in terms of the Democrats watching, see what happens. And then on Tuesday, you have a very big day, so it'll be interesting to see. We're at the same number. A lot of people are getting better, very much better. The 15 number, plus we took it, as you know, from Japan. We took in some great American people and citizens, and they're getting better very rapidly. They're doing very well. All of them are doing well. The 15 people, likewise, we have them down to a much lower number. They're in good shape. Most of them are in really good shape. One of the people is, I wouldn't say not doing well, but she's very sick, but she's hopefully getting better. But we're at the same number. Essentially we've only had 15, and a lot of that's because I called it early. We made a decision very early to close up our borders to certain areas of the world, and we did that. And so we are hopefully getting lower from that number, but let's see what happens into the future. Some countries are doing well, some countries are not doing well. You can see that for yourself. And a lot of things are happening. We're very well organized. We have great talent, great doctors, great everyone. There's tremendous spirit, a lot of spirit. And as you know, with the flu, on average, we lose from 26,000 to 78,000 people a year, even more than that in some cases, some years. We haven't lost anybody yet, and hopefully we can keep that intact. There have been no deaths in the United States at all. A lot of that's attributable to the fact that we closed the border very early. Otherwise, it could be a different story. So we'll just keep doing a good job. We're ordering a lot of supplies. We're ordering a lot of elements that, frankly, we wouldn't be ordering unless it was something like this. But we're ordering a lot of different elements of medical. We are working on cures, and we're getting some very good results. As you know, they're working as rapidly as they can on a vaccine for the future. And with that, I think I can head out. Go ahead. Well, I think it's just people don't know. It's the unknown. You know, they look at it and they say, how long will this last? I think they're not very happy with the Democrat candidates when they see them. I think that has an impact. And we think we're going to win. We think we're going to win easily, but you never know. It's an election. I don't think that's helping. But I think that basically it's the unknown a little bit. But I feel very confident, and our people are doing a fantastic job. And again, we haven't seen an increase, and people are getting better. Almost everybody that we see is getting better. And it could be everybody, too.
And how much time are you spending on it?
No, I'm spending a lot of time on it, just in coordination. Mike Pence is doing a great job. Dr. Fauci is great. They're all doing really a fantastic. Alex Azar is right on top of it. We're all watching it very closely. We don't want any bad surprises.
What is the risk? Do you think economic research help Turkey protect Turkey's soldiers in Syria or not?
What is it?
Should NATO be involved in helping Turkey protect its soldiers in Syria?
You're going to have to speak up. This thing is.
Should NATO be travel ban to countries that aren't allowed in, for example, from Italy?
Well, we're looking at that right now, and we're looking at a couple of countries, a few countries that have a little bit disproportionately high number, and we're going to make that decision very soon.
And then is this a hoax? Our coverage of this was a hoax. Do you think this is a hoax?
Well, I think that the media is, yes, I think that CNN is a very disreputable network. I think they're doing everything they can to instill fear in people, and I think it's ridiculous, and I think they're very disreputable. And some of the Democrats are doing it the way it should be, but some of them are trying to gain political favor by saying a lot of untruths. The fact is, I made one decision that was a very important decision, and that was to close our country to a certain area of the world that was relatively heavily infected. And because of that, we're talking about 15 who seem to be all getting better. One is questionable. And had that decision not been made, it could be a much different story. So some people are giving us credit. Quiet. Some people are giving us credit for that, and some people aren't. But the only ones that aren't, they don't mean it. It's political. It's politics. So speaking of politics, I'm going to South Carolina. I think we're going to do fantastically there, and it'll be very interesting to see what happens tomorrow. Thank you. I think we're going to do very well in the election, but it still is an election. And I don't think people are very inspired when they see the people running on the other side. And so we're going to win, and that'll solve that problem. And after we win, you'll see a rise in the stock market like you haven't seen.
Have you talked to the Fed about intervening or doing something?
Well, I hope the Fed gets involved. I'm not a big fan of the Fed, you know that. I think they make a lot of mistakes. They've made a lot of mistakes. But I hope the Fed gets involved, and I hope they get involved soon. If you look at Germany, they're putting in a lot of money, and they're probably lowering rates still further. You look at other countries, they're all stuffing the till. They're all going in there. They're putting in a lot of money. And our Fed sits there, doesn't do what they're supposed to be doing. But that's up to them. That's up to them. They're independent. But they've done this country a great disservice. Thank you.
Have you finished your annual physical?
President Trump en route to South Carolina, where he's holding a rally tonight. I think the biggest news there in terms of coronavirus is he did say he's looking at travel restrictions on a few countries that have disproportionately more people infected, like they did, for instance, with China. He said the U.S. is well organized, in good shape. We haven't lost anybody yet. Let's get to Eamon Javers at the White House. With Eamon, when we heard the president start talking about the Fed there in the end, I knew that had to be your question.
That's right, it was. He kind of walked around the corner there. I got a couple questions into it, a little hard to hear. I asked him which business leaders he's talking to about the stock market and what they're telling him. And what he said about the stock market was now, I think 4 times he's said this. He said that really what he sees as causing the stock market decline is Democratic candidates for president. He says that's a big element here. So he's pushing that to the top of his list in terms of what's, in his view, causing this market sell-off that we've seen. And I also asked him if he'd talked to the Fed directly about intervening here. He did not say that he has talked to them or called Jay Powell. He did say what he has said before, which is that he's frustrated with the Fed. He wants them to take action. He compares the U.S. central bank to central banks around the world and does not like what he sees, but he didn't say specifically that he's talked directly to Jay Powell there.
Eamon, as always, thank you very much for that. Let's bring in Ian Bremmer, president of Eurasia Group and author of Every Nation for Itself, Winners and Losers in a G0 World. Great great to have you with us, and particularly good timing to react there to the president. How did you sort of rate, and what did you make of what he said just then?
Well, compared to the last week, he's obviously more focused on the seriousness. And we know that Trump is laser-like responsive to the markets. He takes credit for the fact that there have been these record highs. He's now had a brutal week, by far the worst of his administration, and the first global crisis he's had to deal with as president, and he's going to take it seriously. Even the way he responded to the election question. Confident, but a lot more like, we don't know what's going to happen, anyone could win. That's not the Trump you usually see, and that, I think, is a reaction directly to simply stream of consciousness with what he's seen this week. This is a really challenging time for a guy like this to be responding in the United States.
Clearly, it's a hard virus to contain. Was he right to kind of focus there, the president, on the fact that there have been no deaths in the U.S., i.e. that the quality and capacity of care here is probably a lot better than anywhere else in the world?
He's certainly right insofar as the mortality in a country like the United States is going to be a lot lower than it is in China, than it is in Iran. There's a lot more ability to get data. The healthcare services and infrastructure are better. People's underlying health and conditions are a lot greater. So, sure, I don't think in the same way Ebola, when you see in the DRC, it's very different in the United States. Dr. Fauci will tell you that, right? But if you ask me, are we likely to see this pandemic have significant impact directly on the shores of the United States? The answer is yes. And when it does, the fact that we are not only a much more divided country than we were in 2008 or after 9/11, the fact that we are in an election season, which means that there are a lot of candidates that would love to be able to find all sorts of problems with any missteps Trump does or doesn't make, plus the fake news issue. We haven't had a crisis that have had that constellation of problematic variables acting as the backdrop and the context. And I think that's going to make it a lot harder to deal with here in the United States.
I think there's another problem when it comes to responding to this crisis, which is it's a global crisis,
right,
as you said. And a lot of people here have talked about some sort of need for global coordination from a healthcare response from authorities around the world. And this is not a president, and not just President Trump. Really, the trend is G0, right? Every nation out for themselves. So how does that work when it comes to fighting a global pandemic?
Well, so an interesting point, right? The one guy in the administration that's been saying Xi Jinping's doing a good job, let's not beat on him, has been President Trump. Well, you've got Peter Navarro, you've got, a number of officials that have been saying the Chinese are a problem and this is an opportunity for Americans to bring jobs, supply chain, and the rest back to the United States. But when Trump then says, let's have all of this directly through the White House and through Pence, there's no trust for him. So as a consequence, everyone is going to beat up on him and saying it's because you want to just have loyalty. It's an authoritarian China type move. And then you add to that the fact that there is so little international trust. The ability to coordinate between the Americans and the Europeans today is dramatically lower than it was after 2008. The Americans and the Chinese today, dramatically lower than it was in 2008. And in Iran, which is by far the most problematic breakout we've seen so far. Literally, their parliament has been shut down. Their vice president has coronavirus. 2 days ago, the vice president was in a cabinet meeting publicly with the president. And they're not going to get help from the Americans. They can't control their borders. What's going to happen when this hits all the refugees that are presently sitting in northern Syria that are about to be allowed by the Turkish government to go through their borders into Europe? There are all sorts of political problems that are not yet being factored in as part of this coronavirus as it becomes a global pandemic.
Ian Bremmer, always good to get your thoughts. Thank you.
Just want to check in on the markets and remind everyone how we finished here. Extraordinary week. We did rally in the final half an hour of trade or so. That meant that we only closed down 1.4% on the Dow today, so down 12.4% for the week as a whole. Mike, key things we're going to watch over the weekend.
Well, over the weekend, are we going to get anything in the way of indications of central bank response or posture? You do want to see, obviously, there's also going to be a response in South Carolina, the primaries. But I do think that one way to think about the markets going into the week is we had a very, very powerful flush lower, and we went from complacency to outright fear. And I think you did a lot of work to kind of skim away whatever excesses might have been there in the valuations, and you reset expectations much lower. That's all a positive. The S&P 500 spent a lot of time today in the mid-2800s. And why does that matter? It's where we traded in January 2018. It's where we traded back last summer before we were building in much of an expectation for a global recovery in the economy. So I do think you've dialed back in time a fair bit, and I do think that's significant if we look for an opportunity to say that maybe the market can make a stand here.
All right. Don't miss the CNBC special report, Markets in Turmoil, tonight, again, 7 p.m. Eastern Time. And we know Fast Money is about to start. Brian Sullivan is here with us now, has been preparing for this show, Brian. I mean, we're sort of shell-shocked after this week, being here for the close. It was a dramatic final hour of trade every single day. Today was no exception, but the exception was that today the comeback actually stuck. Other days, other final hours of trade, we had not seen that. It was closing at the lows, 2 more than 1,000-point drops.
If nobody's coined it already, I'm going to coin it the bungee jump market because, I mean, that's what it felt like today, right? I mean, just a fast free fall down, and you kind of come back, then went down, we snap back. And, I mean, what a violent move, guys. I mean, I don't know what people are saying down there. And I know up is better than down for most of our viewers, but I wonder if anybody looks at it and says, well, we added 615 points in 15 minutes, up or down. That's a bizarre market move.
It is high volumes, high volatility. And, Brian, we're out of time here on Closing Bell, so take it away.
Yeah, thank you, guys. Everybody go get an adult beverage. Everybody's earned it this week. Sarah and Will, thank you very much. Of course, coverage continues of really this monumental sell-off on Wall Street all week long. Today, no exception. Welcome to Fast Money, everybody. Your traders on the desk tonight: Tim Seymour, Steve Grasso, Dan Nathan, and Guy Adami. Well, tonight on Fast, it is one for the history books. Wall Street just wrapping up its single worst week for the market since really the depths of the financial crisis in 2008. All 11 S&P 500 sectors falling into a correction, meaning they're more than down 10% or more from their highs. The selling has been hard, it has been fast, and really, until late today, they've been indiscriminate. Hard to believe that just last Wednesday, we were talking on this very show about all-time highs. Since then, the broader market down 13%. 18 S&P 500 stocks lost more than 20% this week. All told, the S&P 500 wiped out nearly $4 trillion in market value over the past 10 sessions. That is the budget of the United States of America. So, Guy Adami, as we head into the weekend, I'm going to pull a fast one on you. Fast money one on you. You think we get some...
Fire away.
The big violent move up into the day. You know the chatter, so I'm not saying anything out of school here. Maybe the Fed steps in over the weekend and does something. Do you think we're going to see something from Jay Powell and company this week, your buddies?
Some sort of consolidated global central bank thing, which the answer is yes. Why they think that'll be effective in this is beyond my scope. I'm not an economist. It's more madness on top of the madness they've been portraying for the last few years. But the answer is yes. I think the good news in terms of levels, I'm sure Steve will speak to this 2950 level-ish where we closed. If you go back to the fall of 2018, that's where we topped out before we cratered in December. That's where we retested in the spring and sold off again. So the fact that we traded down and closed there is a very encouraging thing. People will take solace that a lot of these stocks rallied. Some stocks closed in the green. That's all a good thing. But let me tell you something. Mike said something very interesting at the end of